To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Friends, let us now start in day 7, which deals with cash flow statement. And when you look at the financial statement, you have the statement of profit and loss, you have the balance sheet, and another important component of the financial statement is the cash flow statement. Now, cash flow statement is very important if you look at any business. Now, why is cash so important? Why is cash flow for business so important? See, to start a business, you need cash. To pay your expenses, you need cash. To meet the day-to-day, to carry out the operations of the entity, you need cash, right? So, cash becomes the lifeline of any business. And if you look at the cases of bankruptcy, if you look at companies going into liquidation, one of the fundamental reason or underlying reason is they were not able to generate sufficient cash to run their business. Initially, they would be running into losses. They would not be able to generate cash. When they are not able to generate cash, they will borrow money. When they borrow money, they have to pay interest on that. And eventually, they will be in a position where they are not able to pay the interest, they are not able to repay the loan, and the company would go into bankruptcy. The company would be dissolved, the company would be liquidated, or it would be taken over by some other company. But ultimately, when the company does not have cash in their books, or when the company does not have sufficient cash in their books, they will not be able to carry out the operations. They will have to ultimately shut down. Cash, I should say, is the lifeline of any business. In fact, I come from a business family where the cash book is one of the most important book in the business. Every day we have a look at, okay, how much is the cash in hand, okay, how much of income was realized in cash, how much of expenses has been paid, and what is the closing cash in hand. Is that cash sufficient to meet the obligations? That was the most important book when we carry out business, right? Obviously, it's a proprietorship firm and there are no requirements of accrual base of accounting and all of that, but cash is the most important element if you have to ask me about any business. Now, cash can come from multiple sources. It can be from the owner's fund, it can be borrowed funds, it can be profits which are generated and realized in cash. It can be anything, but cash becomes very important. And only by looking at the profit or loss statement or the balance sheet, you will not be able to judge the health of the business entity. For example, there might be a business which is generating lots of profits. It's making great profits. Why? Because the entity is following accrual base of accounting, and on the basis of accrual base of accounting, they have generated huge profits. But if you look at their debtors, or if you look at their inventories, they are carrying a lot of inventories, they are carrying a lot of debtors, the debtors are not paying on time, but the creditors have to be paid on time. And if this cycle continues, ultimately there will be a situation where they are not able to collect money from the debtors and they will not have money to pay to the creditors, right? So though the entity may be making profit, what is important for us to ask is the entity realizing that profit in cash? Is the entity able to convert the profits into cash? That is very important for us to understand if you have to understand the financial health of a business. Just by looking at the profits, you cannot conclude that the entity is doing great. Maybe the company needs more cash to maybe invest in property, plant and equipment, to create fixed assets, or it needs more cash for working capital management. So we need to check how much of cash is generated by the business, how much of cash is generated by the business, and what is the overall cash position of an entity. That is why cash flow statement becomes very, very important. Just by looking at the balance sheet or P&L, we should not be concluding about the financial health of a company. And when we look at cash flow statements, we will be able to look at what is the historical cash flow generated, what will be, and this can be the basis to forecast future cash flows. And you will understand in SFM that a discounted cash flow model, or discounting the future cash flows, is one of the widely used method to value business. It is one of the widely used method to value business. And if we have to value business based on the future cash flows, you need to understand what is the current cash flow of the business, right? So this standard is all about what is a cash flow statement, how should we prepare and present a cash flow statement, right? What are the various requirements, what are the various classifications, how do you reconcile a cash flow statement, and related aspects. Now, if I have to compare this standard with Accounting Standard 3 that you would have already learned as a part of your CA Inter curriculum, there are not many differences between AS 3 and Ind AS 7. Okay, there are few differences. We'll understand them, as we reach them, but there are not many differences if you see AS 3 and Ind AS 7. Obviously, the way we present financial statements under the Ind AS is different. So accordingly, the way you read the balance sheet or the P&L, it would be different. But principally, there is not much of a difference, right? And I assume that you would have learned the basics of cash flow statement as a part of your CA Inter. Like for example, you would have learned about direct method and indirect method. Now in indirect method, we do those working capital adjustments. Now why are we adding a certain working capital adjustment? Why are we deducting a working capital adjustment? I hope you already have clarity on those aspects. And if at all you have not understood the logic of the indirect method, we do have a separate module on accounting standard 3 which explains the logic of doing working capital adjustments, the logic of adjusting various items, the way we calculate various items of depreciation, addition to plant and machinery, and all of those things, right? So there is a detailed module which is available as a part of our course itself. If you feel that you have not understood accounting standard 3 logically, you can refer to those videos and then come back and continue watching these videos. Now, it does not mean that I will not explain the problems in detail. I will be going through each and every problem. I'll explain each and every cash flow statement in detail. But if you want an understanding of why are we adding back reduction in inventory in the indirect method, if you want to understand all of these logics, there is a separate module which we have given as a part of the course. You complete that first and then come back and continue to watch these lectures. Now coming to cash flow statement, what exactly is a cash flow statement? A cash flow statement, friends, to simply put, is the summary of your receipts and payments for a business enterprise. And when I say your cash includes cash equivalents, cash includes cash with bank. We'll come to those specific definitions. But when we say cash flow statement, it is a summary of the cash inflows in the business and cash outflows from the business. For example, the entity may have raised capital. Now, when the entity raises capital, it is a cash inflow. Or the entity has made sales to customers, that is a cash inflow. Or the debtors have paid the amount, that is a cash inflow. There is some other income, it is a cash inflow. The entity has sold property, plant and equipment, there is a cash inflow related to that. So, you have cash inflows which is summarized for the entire year, and then you also have cash outflows. What is the meaning of cash outflows? When you pay certain expenses, let's say salaries are paid, or certain operating expenses are paid, or interest on borrowings are paid, right, or dividends are paid to the shareholders. This is an outflow. Or let us say the company purchases property, plant and equipment, it invests in fixed assets, right? All of these are outflows. So what the cash flow statement does is, it summarizes all the inflows and all the outflows and you present it to the users of the financial statement. So basically, you will have opening balance, cash inflows, cash outflows and the closing balance. And this is nothing but a summary of the cash book of the entity. Though the entity may not be having a separate book called a cash book, but simply put, it is a summary of the cash book of the entity. What is the opening balance? What are the receipts or what are the cash inflows? What are the cash outflows? And what is the closing balance? Obviously, there is a way in which we have to present this particular cash flow. Now, Ind AS 7, like in AS 3, requires that the cash flows of the entity should be split between 3 categories: the operating, the investing and the financing activities. So, you will have cash flow from operating activities, cash flow from investing activities and cash flow from financing activities, right? So, you will split the cash flows into these 3 buckets. Now, before we move forward in the standard, let us quickly understand why do we need to prepare the cash flow statement, or what are the objectives of cash flow statement as per Ind AS 7. What Ind AS 7 says is, one of the objectives of cash flow statement is to provide information, historical information about changes in cash and cash equivalents. Then another objective is to evaluate the ability of the enterprise to generate cash and cash equivalents. So basically, what are the changes in cash and cash equivalents? What is the ability of the entity to generate cash and cash equivalents? So when you look at a cash flow statement, say for example, hypothetically, cash flow from operations are 1000. Cash flow from investing activity is an outflow of 1500. Okay. Now, what you can understand by looking at this statement is, for investments we need 1500, but from operations we are able to generate only 1000. Means we'll have to get some more money from the financing activities. Maybe we have to borrow money, we have to raise money from the shareholders. Wherever it is, we'll have to borrow money, or we'll have to raise money, or we'll have to get fresh investments, or we'll have to issue shares, so that we are able to meet our investment requirements, right? So investment basically means acquiring fixed assets, your property, plant and equipment, etc. So looking at the cash flow statement, a user will be able to understand whether this entity is in a position to generate cash and cash equivalents, right? That is another objective of preparation of cash flow statement. And looking at a cash flow statement, the users will also be able to understand the timing and the uncertainty related to cash flow generation. For example, the debtors balances are continuously increasing, meaning to say the entity is not in a position to quickly convert or convert in a timely manner the debtors balances into cash, and this could be a red flag for the particular business. So these are the objectives of preparing a cash flow statement as per Ind AS 7. Let's now understand few definitions which are relevant in this standard, and then we'll move on to the classification of cash flows. Right. The first definition that we need to understand is the definition of cash. What is the meaning of cash? Cash means cash on hand and demand deposits. So there are two things. One is cash on hand. What is cash on hand? The physical cash that you have, right? That is what is called cash on hand. And the other aspect is demand deposit. What is this demand deposit? Friends, when you put money into a bank, right, you can put into a demand deposit or in a time deposit. Demand deposit basically means that you as a customer can go to the bank anytime and demand the repayment of that deposit. That is what is called demand deposit. For example, you have put some amount in your savings account. Now that amount lying in the savings account, you can withdraw it whenever you want to, right? Nowadays you have ATMs 24/7. Whenever you want to, you can withdraw that money from the bank. The bank cannot refuse it, or the bank cannot levy any penalty on you, because it is a demand deposit. Demand deposit meaning you as a customer can demand the deposit back at any point in time as per your wish. That is what is called a demand deposit. Other kind of deposit is a time deposit, what we generally refer to as, let's say, a fixed deposit. So if you have put a money for, let's say, a 3-year period, that is not a demand deposit, it is a time deposit. Now, does it mean that you cannot ask that money from the bank? You can definitely ask back the fixed deposit from the bank as well. You can go to the bank and say, I want to close my fixed deposit. But then the bank will levy some penalty on you because you have pre-closed your fixed deposit, right? So you need to understand, when you deposit money into a bank or with any other party, it can be a demand deposit or it can be a time deposit. As far as cash is concerned, cash includes cash on hand and demand deposit. Now the standard does not say that it has to be a demand deposit with a bank. It can be a demand deposit with anybody, but till such time it's a demand deposit, it will be considered as a cash component. The next definition that we need to understand is that of cash equivalent. Now what is the meaning of cash equivalent? Cash equivalent is something which is equivalent to cash, or which is almost equal to cash. It is not cash. Okay, what do I mean by cash? Say I have this 100 rupee note, right? Now this is cash for me. This is cash on hand, and I know that this currency note is worth 100 rupees, right? So this is what is cash with me. What is the meaning of cash equivalent? Cash equivalent is something which is almost equal to cash. Say for example, I have created a fixed deposit in a bank for 3 months period, okay? And I know that after 3 months, I will get back my principal and I will get back my interest. I already know it, okay? Will the interest change? The interest will not change, okay? Because we have already decided, we have already agreed with the bank that the interest will be, let us say, 6% per annum. And let us say I have put in 100 rupees of fixed deposit. After 3 months, I know that I will get 100 rupees of cash plus interest on that. Is the amount determined? The amount is already determined. Will this amount change? This amount will not change unless the bank defaults or the bank goes into bankruptcy. Except in that situation, we know that we will get 100 rupees of principal back along with the interest, right? Now this amount is determined, this amount will not change. So this can be called as a cash equivalent, okay? Now take another example. Say I have invested 100 rupees in one particular stock. Let us say I have invested 100 rupees in the stock of Vodafone Idea, okay? Today it is quoting at 10 rupees, for example. Now, can I call this a cash equivalent? Can I call this a cash equivalent? You would see that the share is quoted in the market price is 10 rupees, I have bought 10 shares, so I have invested 100 rupees. Is this a cash equivalent? This is not a cash equivalent because I do not know how much amount will I realize when I actually sell that particular share. For example, if I sell tomorrow and the share price is 9.5, will I get 100 rupees? I will get only 95. Or say the share price becomes 11 rupees, then I will get 110 rupees. So when I am investing an amount in share of a company, I do not know what is the amount that I will get when I actually sell off that investment or dispose of that investment, and hence I cannot call it a cash equivalent. Cash equivalent is something which must be very close to cash. So let's have a look at the definition of cash equivalent as given by Ind AS 7. What Ind AS 7 says is cash equivalents are short term. Cash equivalents are short term. So it cannot be long term, it has to be short term. highly liquid investments, meaning to say you can convert that investment into cash whenever you want to, that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Now there are multiple components which are given in this definition. Cash equivalents are first short term, they have to be short term investments. Then they have to be highly liquid investments. They have to be highly liquid. They cannot be illiquid. Illiquid means you will not be able to sell that investment whenever you want. For example, land is an illiquid investment, but a listed security is a liquid investment. But listed security will not be a cash equivalent because of the other aspect of the definition, which says they are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. The last line is the most important part. That is, the investment should not be subject to significant changes in value. Means it should not be fluctuating. There must not be any risk attached to that particular investment. The risk must be insignificant. Very less chance of fluctuation in value. Only then you can classify something as a cash equivalent. So something which keeps on changing, for example a share price of a security, then you cannot call it cash equivalent. But you have put 3 months deposit in a bank, though it is a time deposit, you know within 3 months, short term, it is liquid as well. It will not change its value. See, the value will not change significantly, and hence that is a cash equivalent, right? So these two are the terms that you need to understand very clearly when we talk about cash flow statements. Cash and cash equivalents. So to summarize cash equivalents are held by the entity for meeting their short-term cash requirements, okay? And generally they are liquid investments. Liquid investments means whenever you want, you can convert that into cash, and this also includes some investments which would mature, let us say, in a 3-month period. So that is what the standard prescribes, that something which is maturing even within a 3-month period or less than 3-month period, that can be considered as cash equivalents. But the most important factor is, from that investment, the amount that you would realize should be known, it should be determined, and there must be insignificant risk of changes in value of that investment. So just because you can sell an investment and get cash does not make it cash equivalent. The important question that you need to ask at the time of making the investment is, what will be the amount that I will get when the investment matures or when I dispose of that investment? Is that value known? For example, in case of a fixed deposit, let's say for a 3-month period or a 1-month period, that amount is already known and determined. And will that amount fluctuate on a day-to-day basis? It will not fluctuate on a day-to-day basis. Whereas, if you invest the amount in equity instruments or if you purchase some mutual fund units, that amount will continue to fluctuate. That amount will continue to fluctuate on a day-to-day basis. There is a risk associated with the market. You'll understand more of it in SFM, and hence equity investments cannot be classified as a cash equivalent, right? And just because you can sell off an investment and convert it into cash readily does not make it a cash equivalent. The most important aspect, as I told you, it has to be short term, it has to be highly liquid, you must be able to know the amount of cash, and there must be insignificant risk of changes in value. Only then you can classify that as a cash equivalent. Now when we talk about cash equivalent, one important aspect that you need to remember when we talk about cash equivalents is with respect to bank borrowings. Generally bank borrowings, let's say there is a term loan or a working capital loan, those are a part of financing activities. Whereas, if there is a bank overdraft or if there is a current account where the balance keeps on fluctuating between being a positive balance to a negative balance, that is, being a credit balance to a debit balance, in such situations, whenever it becomes an overdraft, even then you will consider it to be a part of a cash equivalent, that is, a negative cash equivalent, right? Say for example, there is a bank balance in the current account of 1000, okay? Now, that 1000 of bank balance in the current account is a cash equivalent. And let us say the account becomes overdrawn and now the balance is negative 500. Now this overdraft will also be considered as a part of cash equivalent. So basically you will show it as a negative cash equivalent, right? So with respect to bank overdraft, you need to be clear that it will be a part of cash and cash equivalent, because generally overdrafts are assumed to be an integral part of the working capital management of the entity. It is expected to be an integral part of the operations of the entity, right? And hence bank overdraft will be considered as a cash equivalent unless the overdraft itself is in the nature of a loan, or it is a permanent facility kind of a thing where it is always a negative balance. It's like a working capital loan. In that case, you may consider it to be an item of financing activity, but generally it will be considered as a part of cash and cash equivalents, right? Now we have understood what are cash and cash equivalents. Now if you look at the structure of a cash flow statement, there is cash flow from operating activities, there is a cash flow from investing activities, and there is a cash flow from financing activities. What items go into each of these, we will understand that. And at the end, you will have a reconciliation of cash and cash equivalent. So whatever is cash and cash equivalent will not go into operating, investing or financing activity. They will be shown at the bottom as opening balance, the movement during the period and the closing balance. Let's have a look at few examples and decide whether these items are cash and cash equivalents or not. And we are evaluating this as on 31st March of year 1. Fixed deposit with SBI. What does it say? 12%, 3 years maturity on 1st of January of year 4. So it is anyways a long-term deposit and you have to consider the threshold of 3 months. Please keep this in mind. Please note this somewhere. You have to consider 3 months or less. So this is not a cash or cash equivalent. It cannot be considered as a cash or cash equivalent. Then your fixed deposit with HDFC, 10%. Original term was for 2 years but due for maturity on 30th of June of year 1. Now if you see 30th of June of year 1, it is within 3 months. But what was the original term? The original term was 2 years and hence this cannot be considered as a cash or cash equivalence. You are not looking it as on the balance sheet date or on the cash flow statement date. You are looking at from the time you have created the investment or you have made the investment or you have made the fixed deposit. So here also it is not a cash or cash equivalent. So the next one, redeemable preference shares in ABC Limited, acquired on 31st January of year 1 and the redemption is due on 30th of April of year 1. Now when we get these kind of investments, we have to be extremely careful as to whether these are cash and cash equivalents or not, right? Now what the standard makes it very clear is equity investments are not cash and cash equivalents. So whether it is for 2 months, 3 months, it is not cash and cash equivalents because equity investments will be redeemed or you will realize equity investments either if you sell it in the market or when the investee or the company of which you have acquired the shares goes into liquidation. Other than that, you will not get the money back. So equity investment is out of question. Now what about preference shares? Now here if you see, preference shares have a maturity of 3 months. So they are short term, yes. Are they liquid within 3 months period? We'll assume to be, because it is within 3 months period, we can assume that they are liquid. Okay. Then the third important question that we need to ask is, what is the risk of changes in value? Now the entity has to evaluate whether there is an insignificant risk of changes in value. Say for example, the company is a blue chip company. It is AAA rated, the credit ratings are good. The company is not likely to default on the redemption of preference shares. Say for example, Reliance Industries. Now if you hold the preference shares of Reliance Industries which will be redeemed after 3 months, then there is an insignificant risk, as on today, there is an insignificant risk that Reliance Industries would default in the redemption of preference shares, right? And we will also know what will be the amount of redemption, right? Whether it will be at par or at premium, all of those things would be known. So the question that we need to ask is whether in substance this can be considered to be a cash equivalent. See, generally you would say investments in shares not to be a cash equivalent, but if it is a short term investment in preference shares and the likelihood of the issuer defaulting is very less and there is insignificant risk of changes in values, if all of these conditions are satisfied, then you can classify these as cash and cash equivalents. There is no one standard answer. It can be yes, it can be no, depending on facts and circumstances of the case. So as far as redeemable preference shares are concerned, you can classify them as cash and cash equivalents subject to conditions. Subject to conditions. What are the conditions? Changes in value, the risk of changes in value, and whether in substance the investment is cash and cash equivalent. So it's up to the judgment of the entity whether these items should be classified as cash and cash equivalent. But let us say the entity, when it is making the investment in these preference shares, the intention itself is to make it as an investment and not for cash management purpose or not for meeting the short term cash requirements. In that case, you will not classify it as cash and cash equivalents. You will classify it as a cash flow from investing activity. Cash balance at banks. Now whatever cash balance are present in different banks, they are cash and cash equivalents because you will be able to withdraw them whenever you want. These are demand deposits and hence these are cash and cash equivalents. Cash balances at various banks, international branches, even though they are in international branches, they are cash and cash equivalents. Then cash balances at banks, branches of foreign bank outside India, even these are cash and cash equivalents. There is no restriction as such. Bank overdraft of SBI Fort branch. So Fort is a location in Mumbai. You should visit that place actually. So bank overdraft at SBI Fourth, it is a temporary overdraft which is payable on demand. You have to pay back the overdraft when the bank demands from you, and assuming that this is a part of your overall working capital management, overall cash management, and this is a temporary in nature, this will be a part of cash or cash equivalent. So you will include this. Then treasury bills of 90 days maturity. What are treasury bills? Treasury bills are securities issued by the government. And what is the maturity? 90 days maturity. Now friends, these government securities, they come with the sovereign guarantee, right? You know what is the amount you will receive after the 90 days period or at the time of maturity, and because these are short term, these are liquid and they carry insignificant risk, and hence you will classify them as cash and cash equivalents, right? So this is how we will classify items as cash and cash equivalents. Now with this understanding, we will move on to the next aspect, that is classification of cash flows as operating, investing and financing activities. So now that we have understood the meaning of cash and cash equivalents, let us move on to the next and the most important aspect in the standard, that is classifying the cash flows as operating, investing and financing activities. Now this is one area where lots of students get confused. They try to unnecessarily by heart the definition, they unnecessarily try to by heart the line items, and ultimately they are confused as to whether this item should be under investing or financing or operating. That kind of confusion keeps on coming, right? So before we get into the actual definitions, let me explain to you a very simple logic which will help you understand and remember the classification of various cash flows, right? And for this, we'll go back to our basics. We'll go back to our basics the way we started preparing final accounts, maybe at our 11th standard or at foundation level. From there, we'll try to understand how will we classify these items. And then we'll come to the definition. And let me tell you friends, if you understand this logic, 90-95% of the items would be very simple for you to classify in the cash flow statements. No need to by heart at all, right? So if you look at the P&L and the balance sheet, and I am preparing it in a T-shaped format. So you have a profit and loss and you have a balance sheet, right? You have these two accounts. Now generally, if you look at a P&L and a balance sheet, what are the items that come to your mind, right? Now forget your Ind AS format, forget your Schedule 3 format, concentrate on these two T-shaped formats and try to understand the logic. Now if you look at the P&L, and the first item that comes to your mind would be your sales. Then you may have your other income. Let us say this other income is your interest income. You have made some investments, on that you are getting some interest, or it could be dividend also, okay? These two items. Then on the other side, that is the expense side, you will have purchases. Okay, don't worry about cost of goods sold and all of that. I'll come to one by one of those items. Then you may have your direct expenses. Then you may have your selling expenses. Selling expenses, right? Then you may have your admin expenses. Then you may have your depreciation. Then you would have maybe there is an interest expense, right? There could be income tax. Broadly, this would cover most of the expenses. There would be some small expenses here and there. Let's not worry about that. Largely, these are the items that you would see in a P&L. Okay. Then we also add one more item, other indirect expenses. Okay. These are the major items that you would see in a P&L. And if the sales and the income side, and obviously you'll have closing stock. I'll just put it as changes in inventory, which would be maybe closing stock minus opening stock, and depending on whichever is higher, you will do the addition or deletion, or you can have opening stock here and closing stock here. It would be the same impact, right? Now if you add up the credit side and if you deduct the debits, if you add up the income side and reduce the expenses side, you will get, if at all there is a profit, you would get profit. So let us say you have profit here. Okay. Then come to the balance sheet. In the balance sheet, what all will you see? You would see capital. You may see loans. If at all there are some borrowings, then you would see current liabilities, right? Largely you can classify most of the items on the equity and liability sides into these three items. Now come to the asset side. Asset side, you may have fixed assets. Then you may have investments, right? Based on these investments is where you are getting this income. Okay. Then you will have current assets. Now current assets will include your debtors, your inventories, your advances, all of those things which are under current assets. I am segregating or separating cash and cash equivalents, whatever the definition we learned, right? Largely all of the items would fit into this. Now there could be cases where there are other items also, but this should cover most of your items, 90-95% of the items that you would see on a P&L or on the balance sheet, right? Now, what we need to do is, we need to identify the cash flows, cash inflows or cash outflows, and classify them as operating, investing and financing activity. Now, where could cash inflows come from? Cash inflows could come from sales, it could come from other income, right? Other income. Then if at all you sell off some of the assets, from there also you will get cash inflows. Those are cash inflows item. What are cash outflows? When you make purchases, there is a cash outflow. When you do, when there is a direct expense, there is a cash outflow. Selling expense will be an outflow, admin expense, taxation, right? And there is this item called depreciation. As far as depreciation is concerned, there is no cash flow associated with depreciation. But yes, when you purchase these fixed assets, the property, plant and equipment which we understand, there you will definitely have a cash outflow, right? So, there will be items of inflows and there will be items of outflows. And when you look at the balance sheet, when you are, let us say, purchasing a fixed asset, there is a cash outflow. When you are making an investment, there is a cash outflow. When you are borrowing money, you have loans, right? When you are borrowing money, there is a cash inflow. So, there would be cash inflows and cash outflows associated with these items, which we need to classify into three categories. What are the three categories? Operating, investing and financing activity. Operating, investing and financing activities. In these three buckets, we need to classify those items. Now, how do we classify? First, let us come to operating activity. What are operating activities? These are the activities which form the overall operations of the entity. That is the day-to-day activity of the entity. For example, if you talk about, let's say, Reliance Industries. For Reliance Industries, purchasing of crude oil, processing of crude oil, selling the final product, exporting the final product, all of that is a part of operating activity, right? Now, there would be purchases, there would be manufacturing, there would be sales, there would be advertisement related to that. All of those are related to operations of the entity. They would be classified as operating activity. Now, take a case of a service company. Let's say you take the case of Indigo Learn. Now, as far as Indigo Learn is concerned, when we sell our courses to the student, that is a part of the operating activity. When a faculty records and we are making payment to the faculty, the expense part of it, that is a part of operating activity. When we do advertisement, that is a part of operating activity. When we pay salaries to our employees, that is a part of our operating activity. So, anything which has to do with the operations which generate revenue. So, what you need to understand is operating activities which generate revenues. What are the activities that helps an enterprise to generate revenue? All of them you will classify under operating activities. So, if you look at the P&L, identify the items from which the entity is getting revenue and what are the other items or what are the other activities the entity is carrying out to get those revenue. Now, here if you see, you have sales. Now, sales is related to revenue generation. Sales will be a part of operating activity. So, this entire sales will be a part of your operating activity. Okay. Then, to get sales, what is the entity doing? Entity is purchasing some goods or purchasing raw material. It is incurring direct expenses. It is incurring selling expenses. It is incurring admin expenses. It is incurring other indirect expenses. All of these which are related to the operations, which are related to revenue generation, all of these will form part of your operating activities. Now, depreciation we said is a non-cash item. Okay. Then what about interest expense or what about tax, what about other income, what about changes in inventory, how do we deal all of that? Now, when we look at the other items, let us say interest expense. Now, this interest expense is related to what? This interest expense is related to your loans. Now, when an entity borrows loan, what is the entity doing? Entity is financing the business, entity is financing the working capital, entity may be financing the purchase of plant and machinery. Now, whenever there is an activity of finance involved, now finance can take two forms. It can be own funds, it can be own funds, it can be loan funds. If it is own funds, we call it capital. If it is loan funds, we call it borrowings or loans, right? So, those activities, what the entity is carrying out to finance the business, to finance its overall purchase of, let's say plant and machinery, purchase of fixed assets, financing of working capital. Any activity which has to do something with financing of the enterprise, that will be classified as financing activity. So, this interest expense which is related to loan will be classified as financing activity. Then, capital. this capital also, this capital and loans, which deals with own funds as well as borrowed funds, that has to do something with financing the business, that is classified as financing activity. So whether you raise money from shareholders or whether you borrow money from banks, all of that will be classified as financing activity. One exception would be there, which we have already understood. If bank overdraft is a part of overall cash management, then bank overdraft is considered to be cash and cash equivalent, right? So if there is an interest expense, that will also be a financing activity. Similarly, if we pay dividends to the shareholders, when there is a cash outflow in terms of dividends, that is also a part of financing activities. Then, now, if you look at other items in the balance sheet which are there on the asset side, you have fixed assets, you have investments, you have current assets, you have cash and cash equivalents. Now, cash and cash equivalent is not classified as operating, investing and financing. This is simply your cash and cash equivalent. Okay, this is the last item which will be presented as a reconciliation item. You basically take opening cash, movements and closing cash, and hence this will not be classified as operating, investing or financing. So cash and cash equivalents will not be classified into any of these three activities. Now what are we left with? We are left with fixed asset, investments and current assets. As far as fixed assets and investments are concerned, or any other long-term assets are concerned, they are classified as investment activities. So think of it in this way. A company or an enterprise takes money from shareholders, borrows money from the lenders, that is basically the sources of capital, and uses that capital to invest in, let us say, fixed assets, create property, plant and equipment, your plant and machinery, your cars, your computers, your air conditioners, all of those places the entity is investing the money into. And whatever is the cash outflow related to these kind of purchases of long-term assets, your fixed assets, your property, plant and equipment, or if the entity is making any other investment somewhere else, say for example, in our case we said the entity has invested, let us say, in bonds, or the entity has invested in equity shares of another company. All of these activities, all of the cash flows related to these activities would be classified as cash flow from investing activities. So where do we get the investing activity from? Any outflow related to fixed assets, any outflow related to long-term assets, any outflow related to investment, all of these would be classified as your investing activity. So if you have to see the investing activity, you just need to see the property, plant and equipment, you just need to see other long-term assets, you just need to see the investments made by the entity. All of that would be classified under investment activities. Now, what are we left with? We are left with current assets and current liabilities. See, this cash and cash equivalent directly comes here. We are left with current assets and current liabilities. Now, what would you see in current assets? In current assets, you would see debtors. In current assets, you would see inventories, right? Now, these debtors, these inventories are what? These are related to the revenue generation of the entity. Where do you get the debtors from? When you make a sale. So, anything which is related to operations of the inventory, anything which is related to the operations of the entity, these current assets also would be classified as your operating activity. Similarly, current liabilities are linked with your purchases, your expenses, your salaries. All of these would also be classified as your operating activities, right? Then we are left with this item called income tax. Now this income tax can be in relation to your operating activities, it can be in relation to your investing activities. So if it is related to your operating activities, you will show them under operations. If it is related to your investing activity, you will show them under cash flow from investment activity. Now, for example, if you earn dividends and on that you have to pay tax, then it is a cash flow in relation to investment activity. But the income tax that you pay on profits and gains from a business, that would be classified under operating activities, right? Now, this is a broad understanding. When we do problems, we'll try to spend more time and understand the logic as to how each of these items have been classified, right? Now, to summarize, something which has to do with the revenue generating activities, the principal revenue generating activities of the entity are classified as operating activities. All your sales, your purchases, your direct expenses, your admin expenses, your salary payments, all of those things are operating activities. Any cash flow related to operating activities would be classified under cash flow from operating activity. Now, linked to your sales, linked to your expenses are the current assets and the current liabilities. The movement in those are also classified under operating activities, or they are adjusted when you prepare cash flow from operating activities. Income tax related to the operating activity will be classified as cash outflow from operating activity, right? That is one aspect. Then coming to investment activity, you will have to look at the long term assets, the property, plant and equipments, the fixed assets and investments. That will give you the investment activity. Financing, basically what are the sources of funds? Your equity capital, your preference capital, your debentures, your loans, the borrowings, all of that would be classified under financing activity. And say for example, you have taken a loan. The loan is a cash inflow from financing activity and the interest you pay on that loan. So if you are paying any interest on that loan, that interest will be classified under financing activity. What you need to understand is where is one item being classified, and anything related to that item will be classified under the same head. Okay, so if you are paying interest, that would be classified under financing activities. If you are earning interest, you are earning interest on what? You are earning interest on investments. So because investments are classified under investment activity, cash flow related to investments are classified under investment activity, cash inflows in way of income will also be classified under investment activities. So now that we have understood what are operating activities, investing activities and financing activities, let us have a look at the definitions and take few more examples to understand how do we classify various items or various activities. So operating activities are principal revenue producing activities of the entity and other activities that are not investing or financing activities. So the definition consists of two parts. One, whatever are the principal revenue generating activities, those will be classified as operating activities, and any other activity which cannot fit into the investing activity or financing activity, those will also be classified under operating activities, right? Now, what could be the examples of operating activities? Your sale of goods, cash receipt from customers, payment to suppliers, payment to employees, income tax on the profits of the business, all of these are your operating activities, and any cash flow associated with operating activities will be classified under cash flow from operating activities. Now, when we look at the cash flow from operating activities, that is, what is the cash inflow, what is the cash outflow, and what is the net cash generated from operating activities, what we can understand is how much of cash is the business able to generate from its operation. Now, what will we do with this cash that is generated from operations? Maybe you will use the cash to invest in new property, plant and equipment. Maybe you will use that cash to acquire another business. Maybe you will use that cash to pay dividends to the shareholders. Maybe you will use that cash to pay interest on the loans that have been taken. So basically, the cash flow from operating activities gives us an understanding of how well the business is functioning, how much of cash is the business able to generate from its operating activities, and not from proceeds from shares issue. We are talking about from the principal revenue generating activity, how much of cash is the entity able to generate. Now, being able to generate cash means how much it is able to collect from the customers, how much it is able to realize in form of cash, and how much of cash has it paid, and ultimately what is the cash that remains in the business. That is what gives us cash flow from operating activities. Now, if an entity has a positive cash flow from operating activities, that positive cash flow or that extra cash that is generated can be used to expand the business, can be used to acquire another business, can be used to pay back to the shareholders as dividends. But if the cash flow from operating activity is negative, then it means that the entity is using more cash or consuming more cash in its operations than it is able to generate. And when there is a negative cash flow from operations, the entity will have to raise money, the entity will have to raise finance, it may have to borrow money from outsiders or from lenders, or it may have to issue shares to its shareholders. It has to do something to get that extra cash which can fund the operations, because operations is generating negative cash flows. The operations are not able to generate cash flows, they are actually consuming extra cash, and to meet those cash requirements you will have to look at other sources of finance. Now friends, if you look at a lot of these new age startup companies, right, you take the case of Paytm, you take the case of Flipkart, you take the case of Cred, all of these burn cash. Now, burning cash means what? The cash that they generate from the operations is less than the cash they spend in the operations, or the cash inflows from operations is less than the cash outflows from the operations. They are spending more cash, they are earning less cash. That is called cash burn, right? So, if you have to evaluate any business, if you have to understand the financial health of any business, if you have to understand the liquidity position, will they be able to service the loans, will they be able to pay the loans, you need to look at this item called cash flow from operating activities. Let's now have a look at the definition of investing activities. Investing activities are acquisition and disposal of long-term assets and other investments not included in cash equivalent. So, the standard talks about investing activities as those activities which deals with acquisition of long-term assets, that is one thing, and the second thing is investments which are not included in cash and cash equivalent. So, if an item of investment is included in cash and cash equivalent, you will not show the cash flow associated as cash flow from investing activities. For example, if you have invested, let us say, in government securities with a maturity of 90 days, then that is an item of cash and cash equivalent. So, the outflow on that will not be classified as cash flow from investing activities, right? Now, what would cash flow from investing activities comprise of? Let us say an entity acquires property, plant and equipment. It will be a cash outflow from investing activity. If the entity disposes of the property, plant and equipment, that will be a cash inflow from operating activity. Similarly, if a company acquires investments, let's say shares or debentures of another entity, that would be a cash outflow from investing activities. When they dispose of those, that will be a cash inflow from investing activities. And if they earn income on the investments made, that will also be a cash flow from investing activities. Similarly, if the company has granted loans and advances to other parties, that would be classified as cash flow from investing activities. But if loans and advances are related to operating activities, that would be classified under cash flow from operating activities. Similarly, when the loans and advances are repaid, it will be a cash inflow from investing activities. Then, if the entity deals with futures, forwards, any other derivative contracts, those will also be classified as cash flow from investing activities, unless the dealing in futures, forwards, options, derivative itself is the operating activity of the entity. Otherwise, you will classify them as cash flow from investing activity. Now, when we acquire a property, plant and equipment, we said it is a cash outflow. When we dispose of a property, plant and equipment, there will be a cash inflow, and both of these would be under investing activities. This would be very clear. Now, what happens is, when we sell an item of property, plant and equipment, there could be a gain or there could be a loss. Say for example, the carrying amount of property, plant and equipment is 1 lakh and we sold the property, plant and equipment for 80,000. What is it? Now, what happened in this case? There is a loss of 20,000. What would we do with this loss of 20,000? We would show it as a loss in the P&L, or we would debit the profit and loss account, and it will reduce our profit, right? This 20,000 of loss, should we classify that as an item of operating activity or investing activity? So, generally friends, if there is a loss or gain on sale of property, plant and equipment, that actually is not the cash flow. The 20,000 of loss does not represent any cash flow. For us, the cash flow that is relevant is 80,000. So, 80,000 will be considered as cash inflow from investing activities, cash inflow from investing activities. Then what do we do with this 20,000? That 20,000, when we calculate cash flow from operations, we will exclude that. When we come to the problems, we will understand in more detail, but we will exclude that. Profit or loss on disposal of property, plant and equipment, those are not your cash flow related items. Those are not cash flow from operations, or those are not cash flow from investment. The amount that is realized, the full sale proceeds that is realized, that is what will comprise of your cash flow from investing activity. Now, let's take another example related to property, plant and equipment itself. Say we have a car hire company. Let us say we have Uber. Uber, for example, has acquired cars. It has acquired cars. Now, these cars would be classified as what? Property, plant and equipment. Now, when the company makes payment for this purchase of car, should we classify that as a cash flow from investing activity or a cash flow from operating activity? See, generally we said property, plant and equipment, if you are acquiring, you will classify them as cash flow from investing activity. But if I am acquiring assets, in this case cars, to give it out on rent to others, and my principal business itself is renting out of cars, in that case, I will not classify these as cash flow from investing activities. I will classify them as cash flow from operating activities. I will classify them as cash flow from operating activities. And when, let us say, at a future date, the company sells off those cars, even then the cash inflow will be classified as cash flow from operating activity, right? So, there is no hard and fast rule that something which is an item of property, plant and equipment will always be an investing activity. Now, we took a case where the principal activity itself is giving those assets on rent to others. In that case, acquisition of those assets, acquisition of those items of property, plant and equipment would be classified as operating activities. The rental income will also be classified as cash inflow from operating activities. The final disposal will also be classified as cash inflow from operating activity, right? So you need to understand these specific issues. One, gain or loss on item of property, plant and equipment, that is not a cash flow related item. The cash flow is the actual sale proceeds, and generally the sale proceeds from property, plant and equipment will be classified as cash inflow from investing activity. Even if you are selling it at a loss, the proceeds that you get will be cash flow from investing activity. Whereas if an asset is acquired for giving it on rent to others, then the payment for such asset will be classified under cash flow from operating activity. Please note this point. You might be confused or you might forget these points. These are specific issues that you need to remember when classifying cash flows. Another important thing that you need to keep in mind is, for us to classify any cash flow as a cash flow from investing activity, it has to do something with a recognized asset in the balance sheet. For example, property, plant and equipment. We'll recognize property, plant and equipment as an asset in the balance sheet, and hence whenever there is a cash outflow, we will consider it to be a cash outflow from investing activity. If you cannot recognize an item as an asset in the balance sheet, maybe because you are expensing it out in the P&L, such items cannot be classified as cash flow from investing activity. So, for a cash flow to be classified under cash flow from investing activity, a fundamental rule or the most important aspect is there has to be a corresponding asset, either a PPE or an investment or loans and advances, something, there has to be an asset in the balance sheet. Let's now understand the definition of financing activities. What are financing activities? Financing activities are activities that result in changes in the size and the composition of the contributed equity and borrowings of the entities. So, the own funds and the loan funds, in these two items, whatever causes the changes in the composition, that will be classified as a financing activity. So, basically, it tells us how an entity is being financed, how much of equity is there, how much of owner's funds is there, how much of borrowings are there, and any cash flow which changes the composition of either the equity or the borrowings, that will be classified as cash flow from financing activity. So, let's say you issue shares, cash inflow from financing activities. You take loans, cash inflow from financing activities. You repay the loans, cash outflow from financing activities. You pay dividends to the shareholders, cash outflow on financing activities. Or say for example, an entity has taken an asset on lease. Now when an entity takes an asset on lease, we have understood that you will create something called as lease liability. Now when there is a payment of lease, now that will comprise of the principal payment as well as the interest payment. Now those payments would be classified as cash outflow from financing activities, not from operating activities, from financing activities. Let's have a look at few items and understand whether the cash flow associated with those items should be classified as operating or investing or financing activities. Now we'll identify not only the activity but whether it is a cash flow or not, that also we'll be identifying, right? Now, so we have a mobile phone business and we have to identify the cash flow classification. First, receipt from the sale of mobile phones. Now when you receive money on sale of mobile phones, the first one, receipt from sale of mobile phones. Now when you sell mobile phones, you are getting revenue. There is a cash inflow. So it will be a cash flow from operating activities. Cash flow from operating activities. Then purchase of mobile phones from various companies. Now they have not mentioned whether cash is paid or not. We'll assume cash is paid. So this will also be a cash flow from operating activities. Let me show it in a different color. Then employees expense paid. Now when you pay employees expenses, that is for the operations of the entity. The employees would work, and with the help of that work is when you would be able to get revenue, right? That is related to the revenue generating activity of the entity, and hence this is also a cash flow from operations. Advertisement expenses paid. You make advertisement expenses or you incur advertisement expenses to earn revenues. This also is a cash flow from operating activities. Credit sales of mobile phone. Now, will credit sale of mobile phone be a part of operating activity or not? It is a part of operating activity, but the question that we need to ask is there a cash flow? When you make a credit sale, there is no cash flow, and hence there will not be any cash flow. So, there is no cash flow. Okay, this is what you need to understand. Now, you might be wondering, or if you can recollect, the indirect method of preparing cash flow from operating activities, there we do some adjustments with related to debtors balances, right? At that point in time, we will understand that though this credit sale of mobile is related to operating activity, but there is no cash flow associated with it. Then miscellaneous charges received from customers for repairs of mobile phones. This is also related to the revenue generating activity, so this will be a cash flow from operations. Loss due to decrease in market value of the closing stock of old mobile phones. Now, you have inventory, you have mobile phones. The market value of the mobile phones have gone down. Is there a cash inflow or is there a cash outflow? There is no cash outflow at all. Just the value of the asset has gone down. So, can we say that there is a cash flow from operations? There is no cash flow from operations. So, there will be no cash flow. Now, again here also, when we prepare cash flow from operations under indirect method, we will do the adjustment for changes in inventory. So, if you want to understand the logic quickly, say for example, inventory of 100 is now being valued at 80, right? So, if inventory has fallen from 100 to 80, what is the loss? The loss is 20. Now, this loss you would have reduced from the profit. This loss you would have reduced from the profit while preparing the P&L. So, profit has gone down by 20. But is there any cash associated with this? There is no cash associated with this. So, what do we do? While preparing working capital changes, the difference we will add back. So, 100 minus 80, the difference of 20, we will add back. Why? Because there is no cash outflow at all. It is just a book entry. The value of asset has gone down. The value of inventory has gone down. So, the reduction in inventory will add back to the net profit to arrive at the cash flow, right? When we do a problem, we will again understand this aspect in detail. But just for your understanding that changes in value of inventory is not a cash flow related item. That is why we do that adjustment, right? Then, payment to suppliers of mobile phones. Yes, it's a cash flow from operations. Then, depreciation on furniture. This is a non-cash item. Then, interest paid on cash credit facility of the bank. Now, this is something to do with the financing aspect. So, this will be a cash flow from financing activity. Then, profit on sale of old computers and printers in exchange of new laptop and printer. So, you are giving up an old asset, you are getting a new asset, there is an exchange that is happening and they have not told us whether we have paid additional cash or not. So, if we have not paid any additional cash, it is just an exchange transaction and again here there is a no cash flow. Then, advance received from customers. Advance received from customers is related to operations and hence it will be a cash flow from operating activity. Sales tax paid is related to the sales, the revenue, that is also a cash flow from operating activity, right? So, this is how we classify various items as cash flow from operating activities or a financing activity or a non-cash item or a no cash flow item, right? Now, again, I am just repeating the aspect related to credit sales when the debtor balance changes or the aspect related to changes in inventory. This we will understand this in slightly more depth when we do a problem, and if you have already seen the modules that we have given as a part of the course, you would have already understood the logic why we do those adjustments. Let's look at another question, and this question is to do with the banking business. Now friends, when we talk about a banking business, the operations are completely different. It is not purchase or sale of goods. It is taking deposits and lending money. It is taking deposits and lending money. Now in general sense, if someone would be lending money, then we would classify that activity as an investment activity. But for a bank, the core operation itself is taking deposits and lending money, right? So for bank, taking deposits is an operating activity. Interest payment on deposits is an operating activity. Giving loans is an operating activity. Earning interest on loans is also an operating activity. So you have to be very careful when it comes to a banking business, right? So let's have a look at the items. Interest received on loans, cash flow from operating activities. Interest paid on deposits. Deposits are also a part of the operating activities. So cash flow from operating activities. Deposits accepted means customer have given deposits to the bank. That is also a cash inflow from operating activities. Right, so deposit accepted, cash inflow from operating activities. Loans given to customers, when loans are given to customers, that's also cash flow from operating activity. It's a cash outflow. Loan repaid by the customers, cash flow from operating activities. This is an inflow. I'll just note it, inflow and outflow, it will be easy. Interest received is an inflow. Interest paid on deposits is an outflow. Deposit accepted is an inflow. Loan given is an outflow. Right? Deposits repaid. So, customer gave deposits, it was an inflow. Deposits repaid, outflow. Commission received. Now, commission received, when banks receive commission, Then commission received. Now bank would receive commission for various things, right? That also is a part of the operating activities of the bank. So that is a cash flow from operations inflow. The next item is lease rentals paid for various branches. Now when an entity takes assets on lease, as per Ind AS 116, you would create a lease liability and right of use asset, right? Because here the bank is the lessee. Now if you have a lease liability, then the cash outflow of that would be cash flow from financing activity. But if it is a short term lease and the bank has chosen to take an exemption and not to account for it as a right of use asset and a lease liability, in that case it will be a cash flow from operating activities, right? But otherwise it will be a cash flow from financing activities. Then GST paid. Now GST would be in relation to operations, it will be cash flow from operations outflow. Furniture purchased for new branches. Now furniture purchase is a purchase of property, plant and equipment. It is something to do with the investment activities, so it will be a cash flow from investing activities outflow. Implementation of upgraded bank software, that is also cash flow from investing activities outflow. Why investing? Because we are acquiring property, plant and equipment, we are acquiring intangible assets, we are acquiring long term assets, so that will be a cash flow from investing activities. Then purchase of shares in 100% subsidiary for opening a branch in Abu Dhabi. So they have purchased shares in 100% subsidiary, means what? The entity is investing into a subsidiary, so it is also a cash flow from investing activities outflow. Then new car purchased from Honda dealer in exchange of old cars and remaining amount paid in cash. So whatever is paid in cash is a cash flow from investing activity outflow. Provident fund paid for the employees, cash flow from operations outflow. And issued employee stock options. Now when you issue stock options, there is no cash movement. So it's a non-cash item, or there is no cash flow associated with this particular item. Let's have a look at another set of information, and this is for a general business, okay, not a banking business, but the other normal businesses. So the first item is issued preference shares. Now if preference shares are issued, what happens? There is a cash inflow. And what is the nature of the cash inflow? If preference shares is related to financing activities, so it will be a cash inflow from financing activities, right? Then purchased the shares of 100% subsidiary company, cash flow from investing activity, it is an outflow. Then dividend received from the shares of subsidiaries. So when you make an investment, it is a cash outflow. When you receive dividend, it is a cash inflow, and this cash inflow is from investing activities. So cash flow from investing activities and inflow. Dividend received from other companies. Now whether you receive dividends from a subsidiary or from other companies, it doesn't make a difference. So even that is a cash inflow from investing activities. Bonus shares issued. Now when bonus shares are issued, your equity share capital changes, but the movement is from reserves to the share capital, and there is no cash movement, there is no cash inflow, there is no cash outflow, so it is not a cash item, so it's a non-cash item. Then purchase license for manufacturing of special drugs. When license is purchased, you are acquiring an intangible asset, a long-term asset, and hence it will be a cash flow from investing activity and outflow, right? Then royalty received from the goods patented by the company. Now the company has patented certain goods, and from that the company has received royalty. Then royalty received from the goods patented by the company. So the company has patented certain goods, and from that the company has received royalty. This would be cash flow from operations. So there is a cash inflow from operating activities. Then rent received from let out of building. Letting out is not the main business. Now if letting out is not the main business, then is it a cash flow from operating activity or an investing activity? See, if you own a property and you are giving it out on rent, and giving properties out on rent is not your main business, means it is not your operating activity, it is your investing activity. So cash flow from investing activity and inflow. Then interest received from loans and advances given. Now when loans and advances are given, generally they are classified as investment activities. But if you are giving, let's say, loans and advances to employees as a part of their employment terms or employment contracts, or if you are giving loans and advances to customers or suppliers as a part of your operations, if you are giving advances to suppliers to procure material, then that would be classified as cash flow from operating activity. But generally loans and advances are cash flow from investing activities. Now here what has happened? You have received interest from loans and advances, so there is a cash flow from investing activity, and it is an inflow. Then dividends paid. Dividends paid to whom? You pay dividends to shareholders. So when shareholders give money to the business, it is cash flow from financing activity. When company pays dividend, it is also a cash flow from financing activities. So it's a cash flow from financing activities and outflow. Then interest paid on security deposit. Now what does this mean? The company has taken some security deposit against which the company is making interest payment, right? Now, whether this will be a cash flow from operating activity or a financing activity, it will obviously not be investing because it is not related to an asset, okay? Investment, please note, will always be related to an asset, okay? Generally, when a business takes deposit, that is for operating purposes. For example, there is a contract with the customer. Now the company thinks that the customer may not fulfill the contract, so the company asks customers to deposit some amount as security deposit. Or let us say you have to take a connection, electricity connection, you have to make deposit payment to the electricity department. Similarly, if this company is providing some services, it may take security deposit, right? Now, in this case, it is not clear why these security deposits are taken. So we can assume that this is for operating activity of the enterprise and it is cash flow from operations outflow. Now friends, if you look at the material, they have classified interest paid on security deposits as a financing activity, but generally if you look at security deposits, these are given to safeguard the operating interest of the entity. For example, if I am a telecom company, you are my customer, you have taken a postpaid connection. Now when you take a postpaid connection, I'll ask you to keep some amount as deposit with me. Now why am I taking that deposit? That deposit is not taken to finance my business. That deposit is taken to safeguard my interest, because in the future, if you don't pay your bill, I'll adjust it from a security deposit and I'll disconnect the connection, okay? So generally, this would be a cash flow from operating activity, but if it was something like a public deposit, which you understand in corporate law, you know, where the company borrows money from the public, then in that case, you can classify it as a cash flow from financing activity. Then, purchased goodwill. Acquisition of an intangible asset, so it will be a cash flow from investing activity and outflow. Acquire assets of a company by issue of equity shares, not parting any cash flow, so there is no cash flow, so it's a non-cash item. Interim dividends paid, whether you pay interim dividend or final dividend, it is a cash flow from financing activity, it's an outflow. Dissolve the 100% subsidiary and receive the amount in final settlement. So, when you set up a subsidiary or when you acquire shares in a subsidiary, it is a cash outflow from investing activities. When you realize that amount, when you sell off the subsidiary or when you dissolve the subsidiary and get the payments, then it is cash inflow. From which activity? From investment activity. So, it will be a cash flow inflow from investing activity. Right? So, this is how you classify. So, I hope you have good clarity on how do you classify various items under cash flow from operating, investing and financing activities. So, friends, we have understood cash flow from operating activities, cash flow from investing and financing activities. Let us now move on to the next aspect, that is the method of preparation of cash flows. What are the two methods of preparation of cash flows? I hope all of you remember what you learned in Accounting Standard 3. The two methods to prepare and present cash flow statements are, one, the direct method and second, the indirect method, right? There is nothing new to learn here. You have already learned about this in Accounting Standard 3. So, what is direct method? Under the direct method, what you do is, you basically summarize the cash inflows and cash outflows and present the cash flow statement. So, for example, if there is amount received from the customer, you will say cash received from debtors or cash inflow from receivables or cash received from sales, right? So, for each category, you will summarize what is the cash inflow and what is the cash outflow and then calculate the cash flow from operating, investing or financing activities. Now, when I say we are following a direct method, what we should understand is this is basically a summarization of your cash book. It is a summarization of your cash book. How much of cash is received, how much of cash is paid under each of the heads. That is what is presented under the direct method. Now, please remember, direct method can be used to calculate cash flow from operating, investing as well as financing activities. In fact, for investing and financing activity, you will not be using the indirect method. You will always be using the direct method. How much of amount has been received from the shareholders, how much of amount has been paid to the shareholders as dividend, all of that will be presented using direct method. Now, what is the indirect method? Under the indirect method, what we do is, we take the profit as per the profit and loss and we do some adjustments, we make some adjustments, removing non-cash items, removing items pertaining to other heads, doing certain working capital adjustments. We do all of these and then arrive at the cash flow from operating activity. So under the indirect method, we start from net profit and we try to link the net profits and the cash flows of the entities. As far as investment and financing activities are concerned, as I told you earlier also, you will be following only the direct method. There is no indirect method for it, right? Only when it comes to cash flow from operations, you can use either the direct method or the indirect method. Now, Ind AS 7 encourages usage of direct method, but if you look at the listing agreement or general reporting, what entities do, they follow the indirect method. So basically, you start from the net profit, do certain adjustments and arrive at cash flow from operating activities. Let's now have a look at a question and compute the cash flow from operating activities using the direct method and the indirect method. And friends, I am repeating one more time, if you want to understand the in-depth logic of why a particular adjustment is done, what is the underlying logic of entire this indirect method, there is a separate module on that. Please complete that and then look at this illustration. If you already know the logic, then it's well and good. Okay, so find out the cash from operations by direct method and indirect method from the following information. What they have given us? They have given us operating statement. This is basically your P&L. So there is sales, cost of goods sold, administrative expenses, depreciation, interest paid, loss on sale of asset, profit before tax, tax and profit after tax. Okay. Then they have given the balance sheet. If you look at the balance sheet, you have assets. Under assets, you must get used to this Ind AS way of preparing the financial statements where you see the assets first and then the equities and liabilities, right? So you have property, plant and equipment for year 1, year 2. So this is one thing which all of you should keep in mind. General convention is the latest year is presented here. So the first column represents the latest year and the second column represents the previous year. But sometimes in examination, examiners would switch the columns. So you have to be very careful as to which year are we referring to or which year are we looking at. Okay. So this is year 2 and this is year 1. So you have non-current asset, property, plant and equipment, investment. Then under current assets you have inventories, trade receivables, cash and cash equivalents, shareholders fund, non-current liabilities, trade payables and payables for expenses, right. So this is the information given. Using this information, we are expected to prepare cash flows from operating activities using the direct method and the indirect method. And what we will do is, after preparing the cash flow using both the methods, we will try to compare and see what kind of impact are we giving in each of those cash flow statements. So now in this question, we are required to prepare cash flow from operations using direct as well as indirect method. So first let us prepare using the direct method. Now what happens in case of direct method? You have to take the gross inflows of cash, the gross outflows of cash, and you have to present what is the net cash flow from operations, right. So particulars in a one working for one and the final amount outside, right. Now if you look at the question, you have sales. Now you have sales. Now this sales of 5 lakhs is based on accrual basis of accounting. It is not on cash basis of accounting. So what you need to identify is how much of cash is generated from sales, right. So that is what we need to identify. Now this is sales of 5 lakh. Now it is not necessary that we have realized entire 5 lakhs. So what we need to check is what was the opening balance of receivables and what was the closing balance of receivables. So if you come down to the balance sheet, you can see trade receivables of 7,000 and 10,000. So these two numbers are given. Basically, opening balance of trade receivables is 7,000. The closing balance of trade receivables is 10,000. And during the period, we have made sales of 5 lakhs. Now, using this information, we can easily arrive at how much of cash is collected from debtors or how much of cash is collected from sale of goods, right. Now, there are two ways to do this. One is by preparing the receivables account. The other is by preparing a statement. Whichever way you are comfortable with, you can go ahead with it. For this question, I will prepare using both the methods. As we move further, we will choose one of the methods to be followed. And if you have mastered accounting from incomplete records, all of these adjustments would be just a cakewalk for you, right. So what is the opening balance of debtor? 7,000. Closing balance of debtor is 10,000 and sales is 5 lakhs. So let us plot the information. Cash collected from customers. So if you prepare a statement method, what you do is sales total 5 lakhs. Okay, this is given in the question, right? This is the total sales during the period. Now, what is the opening balance? You add whatever is the opening balance to it, because you have to collect that also from the data. See, this 5 lakhs also must be collected from the data, and the opening balance of 7,000 must also be collected from the customers, right? 7,000. So, 5 lakhs and 7,000, that is what is to be collected. And how much is the closing balance? Closing balance is 10,000. So, what is the cash collected? Cash collected is, so how much is cash collected? Cash collected would be 5 lakhs plus 7,000 minus 10,000. Now, a lot of times students get confused as to whether we should add the closing balance, whether we should deduct the closing balance, what should we do with the opening balance. It is not so complicated. Think of it in a way that you have to get 7,000 from someone. You have to get 7,000 from someone, and you gave another 5 lakhs to that person in terms of sales, right? So, the total amount that you have to collect is 5 lakh 7,000. How much is the closing balance, or how much is still receivable from that person? 10,000 is still receivable, means that person has given you 4 lakhs 97,000. Okay, using this logic you can understand this. Now, we can do the same working by preparing a ledger account as well. Right, so while preparing accounts receivable, to balance brought down. How much is the balance brought down? 7,000. Right, then to sales. How much is the sales? Sales is 5 lakhs. Right, balance brought down is 7,000, sales is 5 lakhs. Then how much is the closing balance? By balance carried down, the question has given us 10,000. Then how much is collected? By bank, the balancing figure is how much? 7,000 plus 5 lakhs minus 10,000, 4 lakh 97,000. Whichever way you are comfortable with. If you want to prepare it using a ledger account, you can do it. If you are comfortable preparing a statement, you can do it that way as well. And for these kind of simple adjustments, right, you can directly write it in the main solution as well. So first, cash collected from customers or sales, whatever it is. Working note number 1, 4 lakh 97,000. This is the cash inflow. Then, are there any other items of inflow? There are no other items of inflow. Now we have to look at the expenses. Now the item of expense that is given is cost of goods sold, which is 3,50,000. Again, this is not based on cash basis of accounting, this is accrual basis of accounting. Cost of goods sold is 3,50,000. Now friends, you have the information about cost of goods sold, right? Now this cost of goods sold would come from what? It would come from purchases. And please note, payment is not for cost of goods sold. Payment will be for the purchases that we have made from the supplier. So, from this cost of goods sold, we need to find out how much is the purchases. And from that purchases, we need to find out how much have we paid to the supplier. So, two things have to be done here. First, find out the purchases. Second, how much of that purchases have been settled, or how much of that purchases have been paid to the suppliers. That is what we need to identify. Now, cost of goods sold is 3,50,000. Now, if you come to inventories, you have 12,000 and 13,000. And to find out purchases, we have to go back to one of the golden equations that you would have learned as a part of accounting or as a part of costing, that is opening stock plus purchases minus closing stock is cost of goods sold. So, working note number 2, cost of goods sold COGS is equal to opening stock plus purchases minus closing stock. This is one formula which you be using multiple times while doing costing, also the same formula, while doing accounting also the same formula, sometimes when you are working in SFM also the same formula. So, COGS or cost of goods sold is opening stock plus purchases minus the closing stock. Now, how much is the opening stock? How much is the opening inventory? Opening inventory is 13,000. Okay. Then, how much is the purchases? That we do not know. That is what we need to find out. How much is the How much is the cost of goods sold? Cost of goods sold is 3,50,000. Okay. Then how much is the closing inventory? Closing inventory is 12,000. Right. Now, with this, can I find out purchases? See, same formula. COGS is equal to opening stock plus purchases minus closing stock. Using the same formula, I can say purchases is equal to COGS plus closing stock minus opening stock. Right. Now even here some of the students tend to get confused. No need to be confused. How much of goods would the company would have purchased? See, whatever they sell, they have to purchase. Okay. Whatever they have to keep in closing stock, that also they need to purchase. Minus, they already have some goods with them. That is what you need to deduct. Okay. A simple logic of this formula. So, if I have to find out purchases is nothing but whatever I have to sell, whatever I need to keep in closing stock, that is 3,50,000 plus 12,000 minus 13,000. So, your purchases is 3,49,000. Now, does this mean that we have paid this entire amount of 3,49,000? We have not paid that. Now, what we have paid can be computed by looking at the opening and closing balance of creditors. So, if you come to trade payables, opening balance is 8,000, closing balance is 12,000. So, what you need to do is amount paid to trade payables. What is the purchases? Purchases we computed is 349. We did not pay the entire amount, right? Now, what we had to pay at the beginning? The question says we had to pay 8,000 at the beginning. So, this is also payable. So, 349 is payable, 8,000 is also payable. Less, what is the closing balance? How much we have not yet paid? 12,000. Correct? 12,000 is what we have not paid. So, how much is the amount paid to trade payables? 349 plus opening balance of 8,000 minus closing balance of 12,000, which is 3,45,000. Right. Now, this is the amount that would have been paid to the suppliers. Again, this amount can be computed by preparing a ledger like we have done here. Okay, if you want, you can practice on your own. So, 345 is the amount paid to trade payables or amount paid to suppliers. So, you can bring that here. Working note number 2, that is 3,45,000, right. So, amount paid to supplier, it's done. Now, let us look at the next item. Administrative and selling expenses 55,000. Now, administrative and selling expenses 55,000. Again here, it is not necessary that we have paid the entire amount, because if you see the liabilities, there is something called as payable for expenses 7,000 and 10,000. So even here, it is possible that we have not paid the full amount. So, for this we need to prepare a working note. Working note number 3, selling and general administrative. That is what the question says, administrative and selling overheads, right. Now, expense for the year. How much is the expense for the year? Expense for the year is 55,000. Okay, and to this we also had to pay whatever was the opening balance. So, add opening balance. How much is the opening balance? Opening balance of payable is given to be 7,000. So, total payable is 55 plus 7, 62, but we have not yet paid 10,000. So, deduct the closing balance. So, how much is paid? It is 55 plus 7, 62 what we had to pay minus 10 what we did not pay. We paid only 52,000. So, here amount paid for selling and general administrative overheads, working note number 3, we got 52,000, right. Then coming back to the question, depreciation. Do we pay something for depreciation? Is there any outflow for depreciation? There is nothing to be paid for depreciation. There is no outflow for depreciation. It is a non-cash item. You will ignore it. Then interest paid. Is interest paid an operating activity? Interest paid is not an operating activity. So, this also you will exclude. Then loss on sale of asset. So, there is an asset which has been sold on which we have incurred loss. How much is the loss? 2,000. Now, is there any cash inflow related to this loss? See, the loss does not represent cash flow. When we sold an asset, there is a cash inflow. But is that a cash inflow from operations? It is not a cash inflow from operations. It is a cash inflow from investing activity. So, this also you will simply ignore, right. Then we have an item called tax. Now, friends, please note, tax has to be presented separately. That is the general standard which is followed. You present the tax component separately. So, we will show it separately, right. Now, so this is all we have. Cash inflow of 4,97,000, cash outflow of 345 and 52. So, what is the cash generated from operations, that is inflow 4,97,000 minus 345 minus 52, you get 1 lakh. 1 lakh of cash is generated from operations. This is before taxes. So, you will say less taxes paid. Now, here if you see tax component they have given to us to be 30,000 and they have not given us what is payable, what was advance tax and all of that. So, we will assume that entire 30,000 of tax is paid. So, tax is paid 30,000. So, what is the net cash generated? Net cash generated from operations is 1 lakh minus 30,000, 70,000. So, this is how you prepare cash flow from operating activities using the direct method. I have purposefully gone slow so that you can catch the underlying logic. As we do more problems, we will make it much faster. Let's now prepare cash flow from operating activities using the indirect method. Okay. Now, when we use the indirect method, what we do is we start from net profit, and the ideal way to start that would be net profit before taxation, or you can start from net profit after taxation and add back the tax component, that is also fine, or you can start with net profit before taxation, that is also fine. Okay, so net profit before taxes, how much is the amount? Net profit before taxes is 83,000. So 83,000, you can start directly from here, or if you start from profit after taxes, you can add back the tax component, okay, because you will only show what is the net taxes paid, you will not show the accrual basis of tax accounting, right? Now, to this net profit before taxes, friends, you will adjust certain items, you will add or deduct certain items which are either not a cash flow or which are not the category of operating cash flows. So, if something is not related to operating activity, that you will adjust. If something is not a cash item, that also you will adjust. So, add less. Okay, what will we add less? So, if you come to P&L, you can see depreciation. Depreciation is a non-cash item, so you will adjust. So, depreciation you will add back. How much is the depreciation? Depreciation is 7,000. Now, why are we adding back? See, this profit that you got, right, 83,000 here, this is on accrual basis of accounting after deducting 7,000. After deducting 7,000. Is that 7,000 actually an outflow? It is not an outflow. So, you are adding this 7,000 of depreciation to ensure that the accrual basis of profit, which is 83,000, actually becomes cash basis of profits. Okay. So, that is the reason why here also you did not see any item called depreciation. So, because depreciation is non-cash item and it has been deducted to arrive at this 83,000, we are adding it back. Then, interest paid. Now, again, interest paid, is it an item of operating activity? It is not an item of operating activity, but we had deducted this item while arriving at the profit. So, now we will add it back. Add interest. How much is the interest? Interest is 3,000. Right. This will be shown separately as an outflow under the financing activity. Then, there is an item called loss on sale of asset. Again, loss on sale of asset is not an item of cash outflow, and whatever is the cash inflow that arises when you sell an asset is a part of your cash inflow from investing activity, friends. It is not from operating activity, right? So, this is one thing you need to keep in mind. So, we will add back loss on sale of assets 2,000. Now, what if there is a gain on sale of asset? You will deduct it. See, because the simple logic is, if you had added something to arrive at the net profit and now you have to exclude that, you will deduct it. If you had deducted something to arrive at net profit and now you want to exclude that, you will add it. A simple logic behind that, right? So, these are the adjustments. Then any other adjustments here? No other adjustments as per the P&L, right? So, the total adjustment will be 12,000 and we call it cash flow from operations before working capital changes or before changes in certain assets and liabilities. Okay. So, 83,000 plus 12,000, 95,000. Then adjustment for working capital changes or certain assets and liabilities. Now, what is this adjustment for working capital changes? One, I will explain you one item of sale, and with that logic you will be able to understand the other items as well. And again, if you want a detailed understanding of that, please refer to the separate module on cash flow statement where I have explained indirect method in detail, right? Now, what is this adjustment for working capital changes? See, the profit before tax of 83,000 has been arrived at after taking into all of these expenses on accrual basis. All of these expenses are on accrual basis. For example, sales. Sales we said 5 lakhs. But did we collect 5 lakhs from the customers? We did not collect 5 lakhs from the customers, right? we collected only, if you go back and see, we collected only 4,97,000 from the customers. We collected only 4,97,000 from the customers. So, 3,000 of cash has not yet been collected from the customers. But for calculating net profit, you took the entire 5 lakhs, whereas you collected only 4,97,000. So, this 3,000 of shortfall has to be adjusted, because what we need is not the accrual basis of profit. What we need is the cash flow, right? So, if you come down to receivables, opening receivables are 7,000 and current receivables are 10,000. So, opening the receivables were 7,000, closing the receivables are 10,000. Can I say that 3,000 of receivables have not paid us the amount? See, assume for a moment entire 7,000 is realized. Entire 7,000 is realized, which means out of these 5 lakhs, we have not received 10,000, or in other words, we have received only 4,90,000. So, 7,000 plus 4,90,000, we have received only 4,97,000. In other words, the movement from my opening to closing, that difference of 3,000 is something which the company has not realized, That is why we reduce this difference of 3,000 while preparing cash flow from operating activities. I am explaining once again. We had to receive 7,000 from the customers at the beginning of the year, and as at the end of the year, we have to receive 10,000, means 3,000 of customers got added who did not pay us the amount, right? But did we consider this 3,000 while calculating profit? Yes, of course, because we have taken the entire sales. So, what we do is, this difference of 3,000, the increase in debtors, we reduce it from the cash flow statement to arrive at the cash flow from operating activities, right? So, less increase in debtors. How much is the increase in debtors? 7,000 minus 10,000, which is 3,000. A small trick for you to do this quickly in the examination: for assets, take opening minus closing. Whatever is the number, whatever is the adjustment, it will automatically happen. For liabilities, take exactly ulta. What do I mean by that is, look at the next item, inventories, 13 to 12. So, you take opening minus closing, 13,000 minus 12,000. So, there is an increase of 1 lakh. So, this will be add decrease in inventories, or the other way to remember this is, inventory reducing means we have sold it, means we have realized it in cash, and hence we are adding it back, if you want to remember. But the best way for you to remember is simply do opening minus closing for the assets. You can note it down somewhere, opening minus closing for assets, and for liabilities exactly ulta, closing minus opening. Okay. Now, coming to next item, cash and cash equivalents, they will not be classified as operating cash flow, so we can ignore that. Coming to the next item, trade payables, opening balance 8,000, closing balance 12,000. What does this mean? From 8,000, the payable balance have become 12,000, means there is an increase of 4,000. Can I say we paid 4,000 less to the payables of whatever we had to pay? Yes, we can definitely say that. You can prepare a statement or a ledger and also understand that we paid 4,000 less to the payables. If you paid less, means we have to add it to the cash flow from operations, right? So, again, for liabilities, simply do closing 12,000 minus opening 8,000, 4,000. So, add increase in payables. Then payables for expenses. Here also it is an increase in payables for expenses. So, here I will adjust it as trade payables. Okay. Now, increase in payables for expenses, what is the amount? 7,000 to 10,000. So, 10,000 minus 7,000, which is 3,000. Okay. So, if you sum this up, you get 5,000. Let me add some lines. So, what is the cash flow from operations? 95,000 plus 5,000, 1 lakh, less taxes paid. How much is the taxes paid? 30,000. So, net cash generated from operations is 1 lakh minus 30,000, 70,000. So, whichever way you do, you get the same answer. Now, one specific thing that I want you to understand and correlate is increase in debtors. How much? 3,000. We have reduced it. Now, come to this working note. Now, here in the working note also, if you see, the total sales figure is lying here, and this total sales would have been considered while calculating your profit, correct? Total sales would have been considered while calculating your profit. Now, if you see the adjustment, 7,000 here and 10,000 here, this adjustment is also of that 3,000. This adjustment is also of that 3,000. Same adjustment we did it here. Similarly for inventory, 1,000. So here if you see, the opening inventory and the closing inventory, the difference that we have adjusted here. Now, here if you see, COGS is 3,50,000 and purchases is only 349, means we are saying that though in the PNL we have considered 350, actual purchases is only 349. So, there is an amount of 1,000 for which there will not be any cash flow, right. So, that is what is adjusted here, and here the same thing we have added back. Similarly, for payables, 8,000 to 12,000, we paid 4,000 less. From 349 to 345, we paid 4,000 less. That is what is being adjusted here, okay. And if you take these two, 4 and 1, 5, what did we do? COGS 350 and trade payable 345, that 5,000 of difference. We have considered 350 as an expense, whereas we have paid only 345. So, that 5,000 has to be added back, and that is what we have done here. Similarly, for payables for expenses, we have done this adjustment and we get the cash generated from operations, right. So, this is how you calculate cash flow from operating activities using direct method and indirect method. The thing that you need to keep in mind when you are using the indirect method is first adjust all the non-cash items, adjust the items which belong to other heads, that is the first thing. Then when it comes to working capital changes or changes in assets and liabilities, if it is an asset, simply do opening minus closing. Simply do opening minus closing. If it's a negative number, reduce. If it's a positive number, add. If you are looking at a liability, do closing minus opening. If you remember this working capital adjustment, these fancy terms would not be difficult at all, right? Let's now have a look at another question, pretty simple one, nothing complicated, right? So, this one will do much faster. Prepare cash flow statement using direct and indirect method. Now, here it's not only cash flow from operations, but the entire cash flow statement, okay. So, they have given us the balance sheet, cash, receivables, prepare insurance, inventory, fixed assets, so on and so forth. Total assets is 3,42,000 current year, 3,27,500 previous period. Then you have accounts payable, wages payable, debentures, equity shares, retained earnings, and total liabilities and equity 342 and 327,500, okay. Then P&L has been given, sales has been given, cost of goods sold, depreciation, insurance expense. So, this is another item. You have wages, net profit, okay. During the financial year 2, company declared and paid dividend of 2,500. So, 2,500 of dividend has been paid, okay. During the year 2, ABC Limited paid 46,000 in cash to acquire new fixed assets. The accounts payable was used only for inventory, that is only for purchases, and no debt was retired during the period. Now, let us take one by one item and correlate back to the financial statements. Dividend of 2,500 is paid and 1,000 is the net profit. Now, if you come to this retained earnings, it was 6,500. It was 6,500. On this 6,500, the company earned a net profit of 1,000. So, it should have been 61,500. From that 61,500, the company paid dividends of 2,500. So, we get 59,000. So, there are no hidden adjustment in this item. Then, fixed assets, 270 is given here and 316 is the closing balance. Now, 270 to 316, if you see, the increase is 46,000. Then, what did they say? 46,000 in cash to acquire new machine. So, no hidden adjustment, right? And depreciation 30 to 45, accumulated depreciation, which is the same as the number given here. So, no complications, no hidden adjustments, pretty simple and straightforward question. Let us get into solving this. So, now in this question also we are required to prepare cash flow statements using both the methods, direct method as well as the indirect method. Now, as far as the direct and indirect is concerned, the difference would lie only in the cash flow from operating activities. For financing and investing, there will not be any difference, okay. So, let us prepare cash flow statement for year 2 using direct method, okay. So, first thing would be cash flow from operating activities, right. Now, when you are preparing cash flow from operating activities, you have to see how much is the cash collected from customers or cash collected from sales, right. Then, what are the items? Cost of goods sold, the cash paid to supplier, insurance expense and wages. Insurance expenses and wages, okay. That is what is related to operating activities. Tax has not been given, so there is no adjustment regarding that as well. In fact, at a final level, they are giving such simple questions for us to practice. It is surprising. Anyways, we will also be providing few more questions from CA Inter, which are more complex than the ones which have been given here. Okay, just for the understanding purpose. See, when you do, you need to understand the logic and the way to solve a problem. It should not happen that once you become a chartered accountant, you are not able to tally a cash flow statement. I have seen chartered accountants, at senior positions, at finance controller level positions, where they are not able to reconcile or tally a cash flow statement. Okay. In fact, when I was an article assistant at my office, my sir used to send me to a couple of companies and used to ask me, Suraj, zara dekh ke aana, cash flow statement match nahi ho raha unka. So that, because unless you understand the underlying logic, it's very difficult for you to tally whether it's a cash flow, balance sheet, P&L. Tallying should be your last problem. You should be able to put the numbers correctly. Balance sheet will get tallied, P&L will get tallied, cash flow will get tallied. There is nothing, because if the trial balance is tallied, then what is the question of this balance sheet and cash flow not tallying? I really don't understand why a lot of students struggle in tallying cash flow statement and balance sheet, right? So understand the logic, practice more and more, ensure that all the items have been taken correctly, then tallying will not be a problem. See, even if you have tallied a cash flow statement, doesn't mean that you have done it correctly, okay? That's also one thing. Come on. So, coming back, we need sales, the cash paid to suppliers, insurance and wages, right? 4 items. I have written all of this. Now, cash flow from customers, working note number 1. For this, we will prepare working note number 2, working note number 3 and working note number 4. In fact, for some of these, you can directly put in brackets also. It's a very, simple calculation. Anyways, working note number 1, cash collected from customers, right? I am preparing a statement format because that is what most of the students struggle to do. You can prepare a ledger format if you are comfortable with, right? Now, cash collected from customers. So, come to the customers balances, accounts receivable, 25,000 and 32,500, opening, closing. So, opening is 32,500 and closing is 25,000. So, sales during the year. How much is the sales during the year? Sales during the year is 2 lakhs. Okay, so 2 lakhs. Now, this is what is receivable. Add what was receivable at the beginning of the period less closing balance. So, opening balance is 32,500. Closing balance is 25,000. Right. So, if you sum this up, you get cash collected from customers 2,07,500. This is the first working note. Then second working note number 2, cash paid to suppliers, right? Now again, using the COGS of 123 and opening and closing inventory, we will find out the purchases. Okay, so purchases is equal to cost of goods sold, whatever you have sold during the period, plus whatever is there in your closing stock minus opening stock. So purchases COGS 123 plus closing stock 37,000 minus opening stock of 34,000. Okay, so how much will this be? This will be 1,26,000. This is what is the purchases. Then how much would be the amount paid to suppliers? Take purchases 126. To this add what was the opening balance, because we should have paid the opening balance as well. So 126 plus opening balance of accounts payable 16,000. What is the closing balance? How much have we not yet paid? Closing balance is 18,000. So minus 18,000, right? So how much is the cash paid to suppliers? If you sum this up, you get cash paid to supplier as 1,24,000, right? Done? Then this is done. Then insurance expense. Is there anything payable for insurance expense? Yes. There is this item called prepaid insurance, 5,000 and 7,000. Now how much is the expense? Expense as per P&L is 11,000. But did we pay entire 11,000? We did not pay entire 11,000. Why? Because there is a 7,000 of prepaid expense, means we have paid 7,000 in year 1 itself, and that has now become an expense in year 2. Again I am repeating, we paid 7,000 in year 1, that 7,000 has become an expense in year 2. So, out of this expense of 11,000, 7,000 was already paid in the previous year. So, less opening prepaid. How much is opening prepaid? 7,000. Then, we have paid another 5,000 which is prepaid expense, which will be expensed in the next period. So, it is not included in this expense. So, add closing prepaid. How much is that? 5,000. Now, a lot of students, what they do is they try to buy hard things. If it is debtors, we'll do this. If it is insurance, we'll do this. Don't do that. Just think of it logically. Expense as per P&L is 11,000. Now, that opening prepaid, is it a part of the expense in the P&L? The answer is yes. But did we pay that 7,000 in the current year? The answer is no. We paid that in the last year. So, it is not a cash flow for the current period. Okay. That is why we have reduced the 7,000 amount. Then, there is a prepaid expense lying in the closing balance. What is that prepaid expense? We have paid in the current period, but it will be expensed in the next period. Meaning to say, it is not included in this 11,000. It is not included in this 11,000. Hence, we are adding it. We are just calculating what is the cash flow associated with insurance. So, if you sum this up, the cash outflow for insurance is 9,000. And lastly, wages. Wages as per the P&L is 50,000. That is the expense. And we have wages payable 7,000 and 4,000. So, 7,000 and 4,000. $50,000 is the expense, right? This is what we should have paid. Add opening payable. Opening payable means whatever is due at the beginning of the period, 7,000, that also we should have paid. So, total outflow would have been 57,000, but we did not pay. How much? We did not pay 4,000. So, 4,000. We just reduce this. So, what is the cash? Cash paid to employees? It is 53,000, right? So, we have calculated 126, 124, 9 and 53. So, 126 minus 124, 53 if I am not wrong, 53 and 9,000. Minus 9,000 minus 53,000, right? So, what is the cash? Is it generated or used? We have to sum it up. 60,000. Negative number means cash used in operations. $60,000. This is done. Then I will just note this as A. Then cash flow from investing activities. Okay. Now, what does cash flow from investing activity comprise of? Now, if you come back to the balance sheet, you have to see assets. See, inventory I have already considered. Okay. Then accounts payable also already considered. Wages also considered. Right. These are financing activities. This is a part of equity. What is left of is fixed assets. Now, fixed assets from 270 to 316, there is an increase of 46,000, and the adjustment also says that 46,000 was spent in cash to acquire new fixed assets. So, cash paid to acquire fixed assets is 46,000. This is the cash flow from investing activities. So, cash used in investing activities is 46,000. Okay, this is B. May add a few more lines. Then cash flow from financing activities. Now, what are the cash flow from financing activities? Now, if you come to the balance sheet, we have also taken this fixed asset is done. This is also done. Okay. Now, equity shares 84 to 88. 84,000 to 88,000 means there is a fresh issue of equity shares to the extent of 4,000, and because no other information has been given, we can assume that the equity shares have been issued for cash. What will we assume? We will assume that equity shares have been issued for cash. So, equity shares 4,000. Okay. Then retained earnings, it has moved from 6,500 to 59,000. That we have already seen is reconciled. What we are concerned about is the dividend which is paid. So, Dividends paid, how much was that? Minus 2500. If you want, you can prepare a statement of retained earnings as well. Opening retained earnings plus profit during the period less dividends paid, and what is the closing retained earnings. Okay. Then we are done with the equity. Now we are left with debentures. What does debentures say? 160 to 173. 160 to 173 means what? 13,000 of debentures have been issued. 13,000 of debentures have been issued means we have raised money by issuing debentures. So, issued 13,000. Okay. Oh, I think it's 207,500. I did a mistake here. This has to be 207,500. Okay. Now, debentures issued 13,000. Okay. So, that is what is given. So, what is cash generated from financing activities? It is 14,500. Okay. This will mark it as C. Now, what you can see here, cash generated from operations is 21,500. Then cash used in investing activity is 46,000. And cash generated from financing activity is 14,500. What does this mean? Basically, the entity has generated 21,500 from operations, and the entity also generated or raised money 14,500 from financing. Using these two, they have acquired certain fixed assets, or they have used it in investment activities. That is how you have to understand this statement. So, what is the net increase in cash and cash equivalents? This is nothing but A plus B plus C. So, how much is A? 21,500 plus B 46,000 minus B in this case plus 14,500. 10,000 is the decrease. So, it is not increase. Okay. So, it is a decrease. In cash and cash equivalents is 10,000. What is the opening cash and cash equivalent? From the balance sheet, if you see, the opening cash and cash equivalents is 14,000. So, what will be the closing cash and cash equivalent? It will be minus 10,000 plus 14,000, 4,000. Is this the same? Yes, this is the same. So, now, after you have prepared this statement, just run through it. You have considered cash, yes. Accounts receivable, yes. Prepared insurance, inventory, assets, depreciation is a non-cash item. Payable is considered, wage payable is considered, debentures, equity and retained earnings, everything we have considered. Now, one peculiar thing about this problem is, though they have mentioned debentures, they have not mentioned anything about interest expense here. Okay. So, it is unlikely the case, but still that is how they have given the question. So, now we have done using the direct method. Let us now do the same thing using the indirect method. Let us now prepare the same cash flow using the indirect method. I will only be preparing the cash flow from operating activities. Balance, investing and financing will be the same. If you want, you can just copy it down from the previous solution. Okay. So, if you have to prepare cash flow using the indirect method, we will start with net profit. Now, here there is no taxes, I will just take net profit. What is the net profit? Net profit is given to be 1,000. So, you will take net profit as 1,000. Now, to this, you will add those items which are non-cash or which belong to any other head. So, add less. What do we have? We only have depreciation. Apart from that, we do not have any other item pertaining to any other head. So, depreciation. How much is the depreciation? Depreciation is 15,000. Now, in exams, if they do not give this kind of breakup, you can find out depreciation by seeing at this particular movement. Okay. So, 30 to 45, 15,000. So, we will add that back. So, cash flow before working capital changes. How much is that? 15,000 plus 1,000, and we will add less working capital changes. Okay. So, just look at the question. Working capital changes. Accounts receivable. Now, as I again told you, for assets take opening minus closing. What is opening? 32,500. What is closing? 25,000. So, it is a positive number, right? Decrease in account receivable. How do you do? Opening minus closing. 32,500 minus 25. 32,500 minus 25,000. 7,500. Then prepaid insurance 7,000 to 5,000. 7,000 minus 5,000, 2,000. Okay. Then inventory 34 to 37. Opening minus closing. So, it will be a minus number. What is inventory? 34 to 37. So, minus 3,000. Then This is done. Fixed asset is investment, that is separate. Then accounts payable 16 to 18. Now increase in accounts payable, you will take closing minus opening. So closing 18 minus opening 16, 18,000 minus 16,000. So it's plus 2,000. Then wages payable 4 minus 7 minus 3,000. Minus 3,000. Then debentures is separate, equity, all of these are done, right? So we have already considered all the working capital changes. So what is the total of this? 3 minus 1 minus 4 minus 2, 5,500, right? So cash generated, net cash generated from operations 16,000 plus 5,500, you get 21,500. Is it the same? Yes, it is the same. Now, what do you understand by looking at this analysis? See, though the profit is only 1,000, the cash generated from operations is 21,500, right? So, this gives a very different picture. That means they have been able to generate more cash from operations. And where did they use this cash for? For investment activities, right? This is how you will prepare using the indirect method. After that, the remaining two sections will be same that we have done above. You can conclude this problem. Let's have a look at another question. So, we have been given the balance sheet and some additional information for a company. We are required to prepare cash flow statements using the indirect method. So, the balance sheet we have non-current assets, property, plant and equipment again for current year and the previous period is given. Then now see, these are net numbers. These are after adjusting the depreciation, right? Then intangible assets have been given 30 to 50, that is after adjusting depreciation. Then you have other financial assets, deferred tax asset net 855, 750. Other non-current assets 800, 770, total non-current assets. Then you have current assets. Under current assets you have financial assets, investments, cash and cash equivalents and other current assets. Okay. Then you have equity, equity share capital and other equity. Other equity basically means your reserves and surplus, your P&L balance, your general reserve, all of those things. Then you have non-current liabilities. Under financial liabilities you have long-term borrowings. You have other non-current liabilities which are given. Then you have current liabilities. Under that you have financial liabilities, trade payables, bank overdraft and other current liabilities. Now, don't get into too much about these financial liabilities and these financial assets and all of this here. When we understand financial instruments, we'll have a more understanding about that, right? So, generally your trade payables is considered to be a financial liability. Trade receivable is a financial asset, okay? Your bank and bank balances are your financial assets. Here your borrowings are your financial liabilities. So, that is what you need to understand. Then you have bank overdraft and other current liabilities, total of current liabilities, total of liabilities and total of equity and liabilities. This is the balance sheet which is given. Okay. Then let us look at the additional information. Profit after tax for the year ended 31st March of year 2 is 4450 lakhs. So 4450, that is the profit after tax. Then interim dividend paid during the year is 450 lakhs. So 4450 was earned, 450 was paid. Now if you see the movement 8,000 to 12,000 under other equity, 8,000 to 12,000 under other equity, that is an increase of how much? 4,000, right? Increase of 4,000. And what is the P&L? 4450 is the profit and 450 is the taxes paid. So how much is the net increase? 4,000. So no further adjustments are there. Okay. Then in depreciation and amortization charged in the statement of P&L during the current year are for property, plant and equipment depreciation, that is 500, and intangible assets and amortization of 20. Now, where will this be useful? After charging depreciation, whatever is the movement in balance, we'll assume that it is a fresh investment in those items and there will be a cash outflow in relation to that, or if there is a disposal, there will be a cash inflow. Okay. Then, during the year ended March 31st year 2, two machineries were sold for 70 lakhs. So, two machines were sold for 70 lakhs. Please note, the value at which the machine would be sold, that is what will be considered to be the cash inflow. The carrying amount of these machines as on 31st March of year 2 is 60 lakhs. So, the carrying amount, that is the net amount in the books is 60 lakhs. Okay. Then, income tax paid during the year is 105 lakhs, that will be an income tax payment item. Then, other non-current assets and liabilities are related to operations and do not contain any element of financing or investing activities. That is, whatever are the other current assets or current liabilities, they are purely for operations, meaning to say, whatever are the changes on that you should account for it as a cash flow from operating activity and not from financing or investing activities, right? Using the above information, construct a statement of cash flows under indirect method. Let us get into the solution. So let's now prepare the cash flow using the indirect method for this particular company, and first thing would be cash flow from operating activities. And what is the starting point? Net profit. Now we don't have before taxes, so we will take after taxes. And friends, by now the moment you write cash flow from operating activities, your mind should say where should you start from. Okay, so what is the question? Net profit. Profit after tax is 4450. So profit after tax is 4450 lakhs. Now to this we have to add back the tax expense. Are we aware of what is the tax expense? Have they given us what is the tax expense? They have not given us what is the tax expense. So we can assume that the income tax, whatever is paid during the period, that itself is the tax expense. So add tax expense. Okay. Now in this question, if you see, there are two things. One, there is an item of deferred tax asset as well, and there is income tax paid. So this tax expense, assuming it is a current tax expense, we'll add it back. And how much is the amount? How much is the amount? The amount given is income tax paid during the year is 105 lakhs. So we will add this back. Okay. Then there is this thing also called deferred tax asset here. Now what is this deferred tax asset? From 750 it has become 855. What is the increase? The increase in deferred tax asset is 105, coincidentally. Okay, it is not that current tax is equal to deferred tax in this case. Coincidentally, deferred tax asset which has been created during the period is also 105x. Now if you recap what you have learned in accounting standard 22, the concepts are still the same. When you create a deferred tax asset, what are you doing? You are reducing your total tax expense. You are crediting an item to the P&L and debiting the deferred tax asset. So can I say that in this period 105 lakhs worth of deferred tax asset was created, and in that process we have credited the P&L by 105 lakhs and we have debited the deferred tax asset. Can we say that? Yes. Now if 105 of deferred tax asset is credited to the P&L, means we have taken it as an item of income. Now tax related items, now deferred tax asset does not have any cash flow. Deferred tax asset does not have any cash flow. So we should adjust this deferred tax asset as well. Because we have credited to the P&L, means we have increased the profit. Now we will have to reduce the profit. Okay, so less deferred tax asset credited to P&L coincidentally is 105 lakhs. Now in normal scenarios, if you would have taken net profit before taxation, this adjustment would not be necessary. Okay, so what is the profit before tax? 4450 plus 105 minus 115, 4450. So profit before taxes, right? Now after profit before taxes, we have to adjust the items which are either non-cash or which belong to some other category of cash flow, correct? Now what are the items which are non-cash? What comes to your mind? Depreciation and amortization as given in the question. So add depreciation, add amortization. How much is the depreciation? The question says depreciation on PPE is 500, amortization on intangible assets is 20 lakhs. So add back 520. Then what is the other item? Then are there any other items? Then are there any other items which belong to some other category? So if you see this third part, you have taken care. Interim dividends are not considered to arrive at profit after tax, so no adjustments needed there. Then yeah, two machineries were sold for 70 lakhs. The carrying amount of these machineries were 60 lakhs. Now what is this? Something worth 60 lakhs we have sold for 70 lakhs. So there is a gain. Now what do we do with this gain? We would have credited it to the P&L, or we would have taken it as an income to the P&L. But is it an item of operating activity? It is not an item of operating activity. So what would you do? You would exclude it from the operating activity, and whatever is the net proceeds, only the proceeds you would show as a part of cash inflow from investing activity, right? So here if you see, you will have to deduct gain on sale of machinery. One last time, why did we deduct the gain on sale of machinery? Because there is a gain. The gain would have been added to the profit. We have to exclude that. So we are deducting. How much is that? That is 60 minus 70, which is minus 10. Okay. So with this, what do we get? 4450 plus 510. This is cash flow from operations before. Now generally we use the term working capital before working capital changes, but in this question they have also mentioned that Other non-current assets and non-current liabilities are also related to operations. So, what we will say is cash flow from operations before changes in operating assets and liabilities. Okay. So, to avoid confusion in the examination also, you can use this statement as a standard rather than calling it working capital changes. Right. Now, let us do changes. Let us do the adjustment for changes in operating assets and liabilities. Now, come to the balance sheet. So, here PPE and intangible assets, those are related to investments. Then you have other financial assets. The question says that is in relation to operating activities. So, other financial assets, if you see 170 to 145, opening minus closing, will it be added or will it be deducted? Please note, for asset it has to be opening minus closing, it's a positive number, it will be added, right. So, it's a decrease, right. So, decrease in financial assets. Here you would say 170 minus 145, 170 minus 145. Then deferred tax asset will not be adjusted, we have already adjusted it. Other non-current assets are also in relation to operations. So, increase in other non-current assets, how much is that? 770 minus 800, 770 minus 800, which is 30. Then next, financial assets, investments are related to investment activity. Cash and cash equivalents are your are the items which you are actually reconciling, so you will not consider. Other current assets 85 to 195, increase in other current assets 85 to 195, which is 110. Then equity is a financing thing. Non-current liabilities, financial liabilities, long-term borrowings, financing activity. Other non-current liabilities, what has happened? It has reduced, decrease in other non-current liabilities. So, it is 3615 to 2740. So, what you would do? 2740 minus 3615. Always remember, liability closing minus opening, assets opening minus closing. Then current liabilities, financing liabilities, trade payables 90 to 150, increase in trade payables, closing 150 minus opening 90, 60. Then bank overdraft. Now friends, bank overdraft as per Ind AS 7 will be considered as cash and cash equivalents if it is an integral part of the cash management. We can assume that bank overdraft is a part of the overall cash management of the entity, and hence that will be considered as cash and cash equivalent. Okay, so you'll ignore that. Then other current liabilities 200 to 300. So increase in other current liabilities 300 minus 200, 100. What is the sum of all of this? 25 minus 30 minus 110 minus 875 plus 60 plus 100, you get 830, right. So, what is the cash generated from operations? 4960 minus 830, you get 4130. Then less income tax paid. How much is income tax paid? 105. So, net cash generated from operations is 4130 minus 105, you get 4025. Then coming to cash flow from investing activity, proceeds from sale of PPE, that is the machinery, is 70, that is given in the question, right, because they have sold it for 70. Then what you need to do is, you need to come to the investment activities, property, plant and equipment. From 12,500 it has become 13,000, right, and there is a disposal also, there is depreciation also, and there would be some purchases also. So, what we will do is, we will prepare an account to find out how much have we invested in property, plant and equipment. Okay. Similarly, for intangible assets also we will prepare a ledger. Property, plant and equipment account to balance brought down, right. Now, how much is the balance brought down? 12,500. Okay. What is the balance carried down? By balance carried down, how much is that? 13,000, right. Then there was a disposal. Now, whatever is the disposal, the book value of that would be excluded from the property, plant and equipment, and here the information is given on a net basis. Depreciation and gross block is not given separately. So, by disposal of fixed PPE, you can say by disposal of PPE, and you can credit 60 year, or you can credit, or alternative what you can do is you can say by bank 70 and here you can say to P&L 10. Okay, so either of the two are fine. You can do this treatment also, or you can say disposal of PPE 60 as well. Then there is depreciation. Depreciation for the period is how much? 500. Okay, so what is the total this side? 13,560. Total this side is 12,500, right? So whatever is the balancing figure, we can assume that it is a purchase of PPE. So to bank 13,560 minus 12,500, you get 1,060. So basically 1,060 is the fresh purchase of property, plant and equipment. So here you would say purchase of PPE 1,060. You cannot show it on a net basis. Okay, proceeds on sale of machinery will be shown on a gross basis. A fresh purchase will also be shown on a gross basis, right? Then we have this intangible asset 30 to 50. Okay, now I want you to prepare the working note for this on your own, because this is a very simple number, right? Now 30 has become 50, and please note there is an amortization as well. How much is the amortization? Amortization is 20. So basically 30 minus 20, it should be 10, but right now it is at 50, means we have invested 40 lakhs in intangible assets. So purchase of intangible assets, so it could be internally generated as well. That is how much? 40. Okay, so this will be a negative number. Then we are done with PPE, we are done with intangible asset. Then we had this investments. What is this investment? 2,500 to 2,300, means we have sold investments. We have sold investments of 200. See, ideally, if there is investment sold, there should be a gain or loss on investment sold. There could be some income on investments. All of this information is not given, and hence we are not considering them, right? So what is the net cash used in investing activity? Net cash used in investing activity is the sum of all of this, that comes to 830. So this you can say A, this you can say B. Then cash flow from financing activity. Now what is the cash flow from financing activity? Now if you come to equity share capital, there is no movement. 300 to 300 means there is no fresh issue of equity capital, but other equity has moved from 8,000 to 12,000, and that we have already seen is because of profits less dividends paid. So directly you can come to the dividends paid, 450 lakhs. It's an outflow 450 lakhs. Then long term borrowings 5,000 to 2,000. Oh, so from 5,000 long term borrowings have come down to 2,000. Means what? We have repaid the long term borrowings. Again here interest numbers are not given, so we are not considering it. But 5,000 to 2,000, 3,000 is the repayment. Repayment of long term borrowings is 3,000. Right? 3,000, 5,000 to 2,000, 3,000. Right? Bank overdraft will be adjusted against cash and cash equivalents. So net cash used in financing activity is 3,450, 3,450. So what is the net increase? Cash and cash equivalents. Net increase in cash and cash equivalents is 4,025 minus 830 minus 3,450, that is 255. Right? 255 is the net increase in cash and cash equivalents. Then what is the opening cash and cash equivalents? 460 minus, don't forget this bank overdraft, 400 minus 60, 400. Opening cash and cash equivalent. How did we get that? 460 minus 60 of bank overdraft, which is 400. So what will be the closing cash and cash equivalents? Closing cash and cash equivalents is minus 255 plus 400, 145, 220, that is nothing but your 220 minus 75. So 220 minus 75. How much is 220 minus 75? 220 minus 75, you will get 145, right? So with this, we have completed the cash flow statements as per indirect method. Now, the things that you need to be careful in this problem or in this question that you need to specifically note is this adjustment for DTA, which is credited to P&L, assumption that this is the tax expense, which is current portion. Coincidentally, both of these are same. Okay. Generally, when you take profit before taxes, these adjustments should not bother you. Then Apart from that, there are no great adjustments in this question. Only thing again that you need to keep in mind is the adjustment of bank overdraft against cash and cash equivalents. That's it, right? So with this we have concluded this problem. Let's move ahead. So now we have understood how to prepare cash flow statements using the direct method and the indirect method. Now there are a few specific things that we need to keep in mind when we are preparing cash flow statements. The first thing is whether we should report cash flows on a gross basis or on a net basis. Say for example, an entity has sold an item of property, plant and equipment for 5 crores and the entity has also purchased an item of property, plant and equipment for 8 crores. So there is an inflow of 5 crores and outflow of 8 crores. Now the question here is, should we present these cash flows on a net basis or on a gross basis? Now what do I mean by net basis? Net basis basically is 5 crores of inflows, 8 crores of outflows. So net outflow of 3 crores. Should we present it that way, or should we say that the cash inflow is 5 crores and cash outflow is 8 crores? So what Ind AS 7 says is the cash flows have to be presented on a gross basis. You cannot net off inflow and outflow and present it as a single item. You have to show inflows separately and outflows separately. So in this case, you will show inflow of 5 crores, outflow of 8 crores. Now take an example. Say there is a bank. Now in that bank, every day customers would deposit cash and the customers would withdraw cash. Customers would transfer funds from one account to another account, from one bank to another bank, right? All of these transactions related to cash and cash equivalents would happen throughout the day at a bank. Now, if the bank has to report cash flow, if it starts saying that, okay, one customer deposited 10,000, so that is a cash inflow, another customer withdrew 5,000, there is a cash outflow. If they keep on doing these kind of, inflow and outflow presentation, the numbers that would appear in the cash flow statement would be huge. So what the standard does is, in some specific circumstances, it permits presentation of cash flows on a net basis. That is to say, if it is a bank and there are some deposits by customers and there are some withdrawals by customers, what the bank can do is, bank can present that cash flow on a net basis, because the cash withdrawn and deposited by customers is not a cash flow of bank per se, it is primarily the cash flow of the customer. See, the bank is acting as a banking agency, the bank is accepting deposits, bank is paying back the deposits or transferring funds, but all of these transactions are basically of the customers, right? So the primary transactions are of the customers. So as far as the bank is concerned, for the deposits made or deposits withdrawn, the bank can present the cash flow on a net basis. So the standard prescribes few situations where the cash flows can be presented on a net basis. What are those situations? The first situation is cash receipts and payments on behalf of customers when the cash flows reflect the activities of the customers rather than those of the entity. So if the transactions reflect the activities of the customers, then the entity can present the cash flows on a net basis. Now some examples for that could be acceptance and repayment of demand deposits of a bank. So whenever there is an acceptance of demand deposits or repayment of demand deposits by a bank, that can be presented on a net basis. Then funds held for customers by an investment entity. Now what do I mean by that? Say for example, there is a portfolio management company, right? Now there are some customers who have deposited money in this portfolio management company, and that money would be subsequently deployed in purchasing the shares on behalf of the customers. Again, the fund movement is primarily the activity of the customer and this PMS is merely acting as an agency. So PMS can show these cash flows on a net basis, that is whatever is received from the customers and how much is deployed by the PMS. Then rents collected on behalf of or paid over to the owners of properties. So if say for example there is an entity and the work of the entity is to manage some property, okay. Now in the course of management of property, this entity collects rent from the tenants and the entity passes on those rent to the owners of the property. So basically say you are the owner of a property and you have a property, let's say located in a different city. Now because you cannot go there and collect rent, what you do is you appoint some agent. Let us say one entity X is the agent who will manage this property. So what this entity does is it collects the rent from the tenants and it deducts whatever are the maintenance expenses, whatever are its agency fees and all of that, and balance is what it remits to you. So basically rent collected by an entity and ultimately remitted to the owner, this can be presented on a net basis by this particular entity. Now these days such kind of transactions would be very less because you can directly transfer funds, you can do some online transfers, but still if someone is collecting rent on behalf of owners and ultimately paying the rent or transferring the rent to the owners, then the cash flows can be presented on a net basis. So this entity did not do that, cash collected from tenants as receipts and cash paid to owners as payments. Instead of doing that, it can do it on a net basis. The second case that Ind AS 7 talks about is where cash receipts and payments are for items in which the turnover is quick. Means, there are a lot of transactions or high volume transactions. The amounts are large and the maturities are short. Now, one example could be an entity issuing credit card. Now, what happens when an entity issues credit card? Say, for example, there is a bank which has issued credit card. You are the customer and let's say Indigo Learn is the seller. Now, when you have to purchase a course on Indigo Learn, what you do is you simply, enter your card details and you purchase a course, right? Now, on the date of purchase of course, you don't need to pay any amount because you have made the purchase using a credit card. Now, who will pay the amount to Indigo Learn? Initially, the bank will pay the amount to Indigo Learn, right? So, bank after deducting whatever are its, charges, there would be some other intermediary that we call at, payment gateways and all of that. Ignore all of those for a moment. Just assume that you purchased a course for 10,000. The bank deducted 1% as its, credit card processing fees and transferred the balance to Indigo Learn. Okay, so Indigo Learn has received the amount and Indigo Learn has given the course access to you. Now, as per the billing cycle, the bank will generate a credit card statement and it will, give the credit card statement to you, and based on the due date, you will make that payment of 10,000 to the bank. Okay. Now, if you look at it from the bank's perspective, what bank is interested in is only that 1% of fees, that is 1% of 10,000, that is 100. That is the income for the bank. Apart from that, whatever it collected from you, 10,000, it passed on 9,900 to Indigo Learn. So, in such cases, the bank can report the cash flow on a net basis, that is a net inflow of 100, because here this transaction involves principal payment by customers, right? So, those can be reported on a net basis. Now, under this category, Ind AS has also given some more examples. One we have already discussed related to credit cards. So, the examples under this category where turnover is quick, amounts are large and maturities are short. One is advances made and repayment of principal amounts of credit card customer. That is the example that we discussed. Then purchase and sale of investment. So, whenever there is a purchase and sale of investment for which some advances have been given and it has been collected back, that also falls in this category. And lastly, other short-term borrowings which have a maturity of 3 months or less. If the turnover is quick, if the amounts involved are large, in such cases, the cash inflows and cash outflows can be presented on a net basis. Then the third category is cash flows related to a financial institution. Now, as far as financial institutions are concerned, then cash receipts and payments for acceptance and repayment of deposits with a fixed maturity date, that is the fixed deposits, they can be presented on a net basis. Then placement of deposits and withdrawal of deposits from other financial institutions, that can be presented on a net basis, and cash advances and loans made to customers and repayment of those advances and loans, those also can be made on a net basis. So, what is happening here, just to quickly summarize, if it is a financial institution and it is accepting fixed deposits or repaying those fixed deposits, that can be presented on a net basis. Then the institution itself is placing a deposit with another institution and it is again maybe withdrawing those deposits, that can be presented on a net basis. And lastly, if advances are given and those advances are repaid by the customers, even that can be presented on a net basis. So, the summary of this discussion or the crux of this discussion is, if cash inflows and outflows are on behalf of the customers, then you can present them on the net basis. Or if the turnover is quick, there are large number of transactions involved in cash inflows and cash outflows, or if it is something related to financial institutions placing deposits, accepting deposits, giving advances, in these scenarios, cash flows can be presented on a net basis. Otherwise, cash flows will have to be presented on a gross basis only. Let's now understand aspects related to cash flows arising from foreign currency transactions. Now, there could be multiple scenarios where foreign currency transactions would come up. There could be a case where, let us say, an Indian company has sold some goods or services to a US entity. So, let us say we have Infosys in India and say, for example, we have a company in the US which has purchased some services from Infosys. Now, when Infosys bills the counterparty in the US, Infosys would be billing the amounts in US dollar. For example, they are billing the amounts in US dollar. Now, if say the invoice value is $10,000 and today the exchange rate is 75 rupees per dollar, then what is the value at which Infosys will recognize revenue? We'll understand, what is functional currency, what is presentation currency, what is foreign currency in detail in Ind AS 21. But for now, just understand that the functional currency of Infosys is rupees or INR, and it has made a transaction in dollars. $1,000 at 75 rupees per dollar. What would be the sale that Infosys would be recognizing? Infosys would recognize 75,000 as revenue or sales. Okay. Now, assume for a moment when the customer remitted the amount, the exchange rate was 80. The exchange rate was 80. Now, how much would Infosys receive? Infosys would receive 80,000 rupees in its bank account. Now, if I were to ask you, how would you prepare cash flow statement in this case? Will you say 75,000 is the cash flow or 80,000 is the cash flow? Now here, please understand, if you are following the direct method, of preparation of cash flows, then whatever is the amount that is received by Infosys, that would be cash inflows. So, if you are preparing cash flows under direct method, we would say 80,000 as receipts from customers to be cash inflow. Okay. Now, under indirect method also the cash inflow will be 80,000, but the computation would be slightly different. How would the computation be slightly different? Let us put numbers onto this Excel and understand that. Okay. So, if you take the P&L of Infosys for these two transactions, you would see revenue from sale of services, so this is in dollar 1,000. Okay, let's say exchange rate is 75. In INR terms, it would be 75,000. Okay, I am not talking about expenses, I am ignoring expenses for now. Then, when the customer remits 80,000, what Infosys would do is, Infosys would say, we have a realized exchange gain on foreign currency transactions. So, there would be a realized exchange gain. How realized exchange gain? Because 80 is the receipt value and 75 is the sale value. So, $1,000, 5 and 5,000. So, what is the net profit? Assuming there are no expenses, okay. The net profit would be 80,000. So, if there are expenses, you can deduct the expenses and cash flow will also be adjusted accordingly. So, when you followed the direct method, what did you do? Directly you took 80 multiplied by 1000, 80,000 as the receipt. Okay. So, here let me write down here. $1,000 at 80, you get 80,000. And when you follow the indirect method, what would you do? You would say net profit. You would say net profit as per P&L. You would say net profit as per P&L, and accordingly you would present that in the cash flow statement, and that net profit itself would become your cash flow because we are not talking about any adjustments. Okay. Now, this is the case when there is a realized gain. The challenge comes when we have unrealized gain. Now, what do I mean by unrealized gain? Say for example, the sale transaction happened in the month of March. And the customer would pay us the amount in April. Now, in that case, how do we present the cash flow? How do we record the cash flow under direct method and under the indirect method? Under direct method, it is very clear because we have not received any cash. We would say cash flow from operations to be 0. Cash flow from operations would be 0. Again, I am assuming we have only this single transaction. Cash flow from operations would be 0. But if you look at the indirect method, then how would you do the accounting for it? So, let me just copy the same example. And assume for a moment that this gain is not realized, there is an unrealized exchange gain. And assume this is the first year of operation, there are no other transactions. Okay, this is the unrealized exchange gain of how much? 1000 multiplied by 5, 5000. Why? Because exchange rate on 31st of March of year 1 is 80. Exchange rate is 80, and hence what did we do? We restated the monetary items. You would have learned this concept in AS 11. We'll understand these concepts in detail in AS 21 as well. So don't worry about that. What did we do? We restated the receivables from 75,000 to 80,000. So this restatement created an unrealized exchange gain of 5,000. Now friends, in this entire 80,000, have we received any amount? We have not received any amount. We have not received any amount. Then how much will be the cash flow? Cash flow would be 0, just now we discussed. But under indirect method, how would we show that? So what would you do is, under indirect method, you would take net profit. Net profit of how much? 80,000. Okay. Then what would you do? You would do adjustments. Now when you talk about adjustment, the adjustment would be one related to changes in value of operating assets and liabilities, right? So now here, assume for a moment opening debtors were 0. What is the value of ending debtors? How much is the amount receivable from the customer? 80,000, not 75,000. Why 80,000? Because the exchange rate on 31st March has gone up to 80, and hence we would say amount receivable from the customer is 80,000. So that is my closing debtor balance. Now we know when we do this asset adjustment, we take opening minus closing balance. So you would do increase in value of debtors. Opening minus closing. Opening is 0, minus closing is 80,000. So you have minus 80,000. So 80,000 minus 80,000, it becomes 0. So please note that even though you are following indirect method, even then the cash flow from operations would be automatically adjusted with any unrealized gain or realized exchange gain. If it is an unrealized exchange gain, the debtor balance would increase and automatically it would be adjusted when you do the adjustments to assets and liabilities. If it is already realized, then through this gain entry, it would automatically appear in the cash flow statement. Adjustments would automatically happen. So if you are following indirect method, you don't need to do any specific adjustment for this unrealized gain or loss. Okay, so that is one aspect. Even whether it is realized or unrealized, you don't have to make any specific adjustments. It will be automatically taken care for. When you are following direct method, you will take it as a cash inflow only when cash is received. Exactly reverse would be applicable when you are doing a outflow related transaction. Now there could also be a case where cash and cash equivalents are held in a foreign currency. Say for example, again we are talking about an Indian entity whose functional currency is INR and they have, let us say, $500 of cash in hand or $500 of cash at bank. Okay, that is possible. You can have a dollar denominated bank account or you yourself may have a physical currency in dollars, right? Now in that case, we are holding cash and cash equivalent in dollars and we know that the exchange rates keeps on fluctuating. Say for example, this is year 1 and this is year 2. Year 2, okay. Cash and cash equivalents. INR, let us say you have 10,000 and USD, let us say you have $500, okay, you have $500, right. Now, say for a moment during the year there were some cash receipts and some cash payments, okay. So let us say receipts from customer in year 2, this is the closing balance at year 1, receipts from customers say for example is 25,000 and payment to supplier is say for example 20,000. I am keeping it very simple, okay. Now, what will be the cash balance at end of year 2 and assume for a moment this dollar we did not touch, okay, that $500 whatever we had at the beginning of the year is also with us at the end of year 2. Now what will be the closing cash or cash equivalents for INR? You have 10,000 of opening balance plus receipts of 25,000 minus 20,000 of payments. So you have closing balance of 15,000, okay, and assume for a moment here, I will just add the exchange rate also. Exchange rate here was 75. So INR equivalent for USD held is how much? 10 is 500 multiplied by 75. So 37,500 and total would be 37,500 to plus 10,000, you get 47,500. That is at the end of year 1. Now during year 2, your closing INR balance is 15,000 and assume for a moment the same $500 is with us, but this exchange rate has now gone up to 80. The exchange rate has gone up to 80. Now what is the INR equivalent for USD held? It is 40,000. And what is the total cash and cash equivalent? It is 55,000. It is 55,000, right? Now if you see the increase in cash and cash equivalents, there is an increase of 7,500. Now out of this 7,500, I know that 5,000 comes from here. 10,000 has become 15,000, or here if I do a net increase 25,000 minus 20,000, the net cash inflow is 5,000. So 5,000 up comes from here. Okay, and the balance 2,500 comes from here. Now 5,000 is my actual cash inflow. It is my actual increase in cash and cash equivalents, but this 2,500 is a notional increase, though it is a gain. See, you will post it as a gain in the P&L, though it is a gain, I have not received any extra cash. There is no cash flow associated with this gain. I had $500 at the beginning, now also I have $500. Exchange rate was 75, which has now become 80, but there is no cash flow associated with it. But is it a part of cash and cash equivalent? Yes, it is a part of cash and cash equivalent. So then how will I present this in the cash flow statement? So what you need to do is, when you are preparing cash flow statement, you would say cash flow from operating activities. How much did we calculate? 5,000. Okay, that itself is the increase. So net increase in cash and cash equivalents is 5,000, right? Opening cash and cash equivalents is 47,500, is 47,500, right? To this you will add the gain that you have made on currency in hand. So add gain on currency at hand. How much is that? Gain on currency at hand was 2,500. So closing cash and cash equivalents will be 5,000 plus 47,500 plus 2,500, that is 55,000. Now 55,000 is closing cash and cash equivalent. Out of that, 5,000 is from operations and 2,500, this is a reconciliation item. This is a reconciliation item. So whenever you have cash and cash equivalents in hand, or whenever you have cash and cash equivalents which are due, let us say there is a short-term bank overdraft which is in a foreign currency, that is also part of cash and cash equivalents. Now these foreign currency cash and cash equivalents, you will convert them into equivalent functional currency, in our case equivalent INR, using the closing rate, and whatever is the gain or loss, that will become your reconciliation item. Please note, this is not a cash flow from operating, investing or financing activities. This 2,500 is a reconciliation item, basically explaining the movement of cash and cash equivalents in foreign currency at the beginning and at the end. Let's have a look at a question on foreign currency. Z Limited has no foreign currency cash flow. So there is no foreign currency cash flow, no foreign currency inflows or outflows. It holds some deposit in a bank in the US. The balances as on 31st December of year 1 and 31st December of year 2 were US dollar 100,000, that is 1 lakh, and US dollar 102,000, that is 1 lakh 2,000. The exchange rate on December 31st year 1 was 45, and the same on 31st December of year 2 was US dollar 1 is equal to 50. So from exchange rate from 45 has gone up to 50. The increase in the balance was on account of interest credited on 31st December of year 2. How these transactions will be presented in the cash flow for the year ended 31st December of year 2 as per Ind AS 7. Now here the financial year is ending on 31st of December of each year. Opening balance is US dollar 100,000, closing balance is 102,000. So let's note down the details. Particulars. This is year ended 1 and this is 2. Cash and cash equivalents. Now why am I saying cash and cash equivalent? Because the question says deposit, it does not talk about a time deposit or an investment. So I am assuming it is a cash and cash equivalent, and it is 100,000 at the beginning and 102,000 at the end. Just increase this slightly. And the question says the exchange rate is 45 and 50. Okay, so what will be the cash and cash equivalent in INR, that is the functional currency? This is USD. So 100,000 multiplied by 45, you get 45 lakhs, and here you get 51 lakhs. Okay, so this is the increase in cash and cash equivalents, that is 6 lakhs. 6 lakhs is the increase in cash and cash equivalent. Now, is the entire increase on account of change in exchange rate? Entire increase is not on account of change in exchange rate. If you see, the question says 2,000 of interest is credited. Now, this 2,000 of interest is what? This is your income. So, if you see your P&L account or profit and loss statement, you will have other income, which is interest. How much is that? For year ended 31st December of year 2, you will have 2000 of other income, and it was credited on the last date of the year at which the rate was 50. So 1 lakh of interest is credited. Now the interest income is 1 lakh, and apart from this there is another income, that is gain in the value of currency. You had 1 lakh US dollars at 45. Now the same 1 lakh dollars you are holding at 50. So there is a gain of 5. So you will have unrealized gain on cash and cash equivalents, or you will have unrealized gain on USD holdings or USD currency. Okay, how much is the unrealized gain? 1 lakh, that is 100,000, multiplied by 45 to 55. So you have 5 lakh of gain. So what is the net profit for the period? Net profit for the period is 5 lakhs plus 1 lakh, that is 6 lakhs. Now this net profit for the period includes both your interest income as well as unrealized gain on USD holdings or USD currency. Now tell me one thing, is there any cash inflow associated with the interest income? Did we receive any cash with respect to interest income? Yes or no? Now you might be thinking, sir, the amount is credited to USD bank account, but we have not received in India. Don't think in that way. Think of it as an entity. As an entity, the entity has received $2,000 of interest because the cash and cash equivalents in USD terms have gone up by 2,000, right? So this is definitely a cash inflow, whereas this 500,000 is not a cash inflow because cash has not increased. Cash has not increased. Now sir, why are you saying cash has not increased? Cash has not increased because your $1 lakh are still $1 lakh. The value of that cash equivalent has increased, but it is still $1 lakh. So there is no real cash inflow associated with it. But $2,000, I can see an amount being credited to my bank account, that is a cash inflow or a real cash inflow. Okay. Now, if you have to prepare a cash flow statement, what would you do? You would say cash flow from operations. You would say net profit for the period. How much is the net profit for the period? 6 lakhs. Then you will adjust a non-cash item. What is the non-cash item? This 5 lakhs is a non-cash item because there is no cash inflow associated with this 5 lakhs. So less unrealized gain on USD. How much is that? 5 lakhs. Okay. So what is the cash flow? Net increase in cash and cash equivalent. 6 lakhs minus 5 lakhs, we have 1 lakh. But there is a gain on USD currency. So that 5 lakhs of gain will be a reconciliation item. Add opening balance of cash and cash equivalent. How much is that? 45 lakhs and add unrealized gain on USD 5 lakhs. This is your reconciliation item. This is your reconciliation item, and hence your closing cash and cash equivalent is 50 lakhs. So this is your closing cash and cash equivalent. Now friends, please note, whatever is an item of cash and cash equivalent, on that if there is any unrealized gain or loss, that is not a cash flow from operating, investing or financing activities, it is a reconciliation item. Let us now understand cash flows associated with interests and dividends. So an entity can receive interest, they can pay interest. An entity can receive dividends, they can pay dividends. How do we classify this in a cash flow statement? Now generally, if an entity pays interest, that is classified under financing activity because interest payment is a cost for obtaining finance. Similarly, when an entity pays dividend, that dividend is classified as a cash outflow from financing activity because you are paying these dividends to whom? To the shareholders. This is basically a cost of obtaining finance. So interest paid or dividend paid, both of these are cash flows from financing activities. Now when it comes to interest received or dividends received for a normal entity, that would be cash flows from investment activity, because you receive interest on investments made. Maybe you have placed some long-term fixed deposit, or maybe the entity has purchased some debentures, maybe the entity has purchased some bonds on which interest is being received. So such interest will be classified as cash flow from investing activities. Similarly, if there is an investment made in shares and the entity receives dividend income, that would be classified as cash flow from investment activity. So that is generally. Now there is an exception in case of a financial institution. What is the exception? As far as a financial institution is concerned, say for example a bank. Now when does a bank pay interest? Bank pays interest on deposits. Bank pays interest on deposits. So when bank pays interest, then that is considered to be a part of the operations of the bank. It is not a part of financing. It is a part of the operations for the bank. So when a bank pays interest, then that is classified under operating activities. Similarly, when a bank receives interest, that is also classified under operating activities. Now, there may be a possibility that bank receives dividends also, that is also classified as a part of an operating activity, right? So these items which form the core of operations of financial institutions, that is interest paid, interest received and dividend received, all of those are classified under cash flow from operating activities. Now what if a financial institution pays dividend? That is classified as cash flow from financing activity. So to summarize, generally interest paid, dividends paid are cash outflow from financing activities. Interest received, dividends received are cash inflow from investing activities. In case of a financial institution, interest received, dividend received and interest paid, all of these three are classified under cash flow from operating activities. Dividends paid is classified as cash flow from financing activity. Let's now move on to the next aspect, which deals with cash flows arising from taxes on income. Now what are these taxes on income? See, when an entity carries out business, they have to pay taxes for that. When there is an investment income, a dividend income or an interest income, taxes has to be paid on that. Where there is a capital gain, taxes has to be paid on that, right? So as far as an entity is concerned, there would be taxes associated with the income. Now when it comes to taxes paid, the actual tax outflow, we are not talking about tax expense, we are talking about actual tax outflow, whatever the advance tax or self-assessment tax that an entity pays, or some tax has been deducted at source or some tax has been collected at source, we are talking about these aspects. Now whenever an entity pays tax, what the standard says is the cash flows on taxes should be classified as cash flows from operating activities unless they can be classified under investment or financing activity. Now what do I mean by that? Say for example, an entity has paid 10 lakhs of taxes. They have paid 10 lakhs of advance tax. Okay. Now this 10 lakhs of advance tax paid during the year will be shown as a cash outflow from operations unless you can attribute or you can quantify what portion of this advance tax is for other activities. Say for example, there is a capital gain during the year and 1 lakh out of this 10 lakh is for capital gain related income. So in that case, 9 lakhs will be shown under cash flow from operations and 1 lakh would be shown under cash flow from investing activity. Basically, cash outflow on account of taxes under operations 9 lakhs, under investment activity 1 lakh. Now if you cannot attribute, if you cannot bifurcate, then in that case you will have to show them under cash flow from operating activities only, right? So to summarize, there can be tax related cash flows under operating activities, there can also be tax related cash flows under investing activities or financing activities. Now under financing activities, earlier there used to be something called as dividend distribution tax, which was tax paid on dividend declared by the entity, right? So such cash flows would come under financing activities. So what the standard requires is cash flows on account of taxes should be disclosed separately. And second thing is, you will classify the cash flows on account of taxes under operating activities unless you can attribute them or you can allocate them or you can show them under investing activities or financing activities. Let's have a look at a question. During the financial year ended year 2, Akola Limited have paid various taxes and reproduced the following mentioned records for your perusal. Capital gain tax of 20 crores on sale of office premises at a sale consideration of 100 crores. So now here there is a sale consideration of 100 crores. Now where will you classify this? This will be classified as cash inflow under investing activities. And there is a capital gain tax of 20 crores. So this capital gain tax of 20 crores will be what? It will be cash outflow under investing activities under taxes, right? So this is basically a tax outflow under investing activities. Then income tax of 3 crores and business profit amounting to 30 crores, assuming entire business profit is cash profit. So entire 30 crores is cash profit, meaning to say cash flow from operations is 30 crores less income tax of 3 crores. So that will also be shown under operating activity. Then dividend distribution tax of 2 crore on payment of dividend amounting to 20 crores to its shareholders. Right now we don't have dividend distribution tax, but still dividend is a cash outflow under financing activity. And dividend distribution tax is also a cash outflow under financing activity. Please note friends, it is not that on 20 crores you will reduce 2 crores and pay 18 crores to shareholders. It did not work that way. The way it worked was 20 crores would be paid to the shareholders and 2 crores would be paid to the government as dividend distribution tax. And income tax refund of 1.5 crores, refund on taxes paid in earlier period. So, where will you show this? This is a cash inflow on account of tax under operating activities. Earlier, we would have paid some taxes, maybe advance tax or by way of TDS, now which is being refunded by the government. So, there will be a cash inflow under cash flow from operating activities. So, to summarize, what all will go under cash flow from operating activities? Cash flow from operating activities, business profits realized in cash 30 crores, less income tax paid 3 crores, and income tax refund 1.5 crores. So, 30 minus 3 plus 1.5, you have 28.5 as cash flow from operating activities. Then, under investment activities, you have sale proceeds from sale of office premises, that is 100 crores, less capital gains taxes paid 20 crores. So, 100 minus 20, 80 is your cash flow from investing activities. And lastly, dividend paid 20 and dividend distribution tax paid 2. Both of these are cash outflow under financing activities. So, minus 22. So, you have cash flow from operating activities of 28.5 plus cash inflow from investing activity of 80 minus cash outflow from financing activity 22. The net cash inflow or the net increase in cash and cash equivalent is 86.5 crores. Let us now understand how do we deal with non-cash transaction. Let me give you a very simple example. Say there is a company and the company wants to purchase some property, plant and equipment, and the value of the property, plant and equipment is 10 lakhs. Now, there could be one scenario where the company issues equity shares for cash, it collects cash or amount in the bank and uses that amount to purchase the property, plant and equipment. Now, what would happen in that case? You would say there is a share issue or there is a cash inflow from financing activity, and while purchasing the property, plant and equipment, you would say there is a cash outflow on investing activity, right? So, that part is clear where cash and cash equivalents are involved. You collect cash from the shareholders and you pay that amount or use that amount to purchase a property, plant and equipment. But think of a situation where the company acquires property, plant and equipment by issuing shares to the vendor or to the seller. That is, the company has purchased property, plant and equipment, but the company did not pay cash and cash equivalents, but the company issued equity shares. Now, in the second case, is there any cash flow involved? There is no cash flow involved. Now, how do we disclose such items in cash flow statements? We will not disclose such items in cash flow statements. Then, how will the shareholders know, how will the stakeholders know that there has been an issue of shares, there has been a purchase of property, plant and equipment, and that is a non-cash transaction, for which what Ind AS 7 requires is, if there are any non-cash transactions, they have to be appropriately disclosed. So, there may not be cash involved, but there is an increase in property, plant and equipment, there is an increase in share capital. Disclose that fact appropriately in the financial statements. Now, you might have a question as to why should we disclose acquisition of property, plant and equipment by issue of shares separately? Please understand friends, when you are issuing equity share capital, there is a change in capital structure. You are adding an item of property, plant and equipment that has an impact on the asset structure, right? Your return on capital employed would change. The entire structure of the balance sheet changes, and even though there is no cash flow involved in this, what the standard requires is, don't show it as a part of cash flow statement, but disclose it appropriately in the financial statements, provide relevant information to the users of the financial statements. Now, I have to give you some more examples of non-cash transactions. There could be a conversion of debt into equity. So, there could be, let us say, a debenture outstanding and the debenture has been converted into equity, right? So, from one capital source, you are moving the amount to another capital source, but there is no cash flow involved. So even that would require a separate disclosure in the financial statements. Or there could be a case where a property has been taken on lease. Now, when you take a property on lease, you will suddenly add right of use asset and you will create a lease liability. But you will only be disclosing the lease payments related cash flows in the cash flow statement. Overall increase in asset, overall assumption in lease liability have to be appropriately disclosed elsewhere, right? So whenever there are non-cash transaction involving an investing activity or a financing activity, see, under operations you anyway have debtors, creditors, payables, receivables and all of that. Under investing activities and under financing activities, if there are any non-cash transactions, that has to be appropriately disclosed separately in the financial statement. Now say for example, if you purchase the same property, plant and equipment by paying, let's say, 4 lakhs in cash and 6 lakhs by way of issue of equity shares, then how would you present that? 4 lakhs of cash payment would be shown as a cash outflow under investing activity in the cash flow statement, and the balance 6 lakhs you would disclose it appropriately in the notes to financial statements. Let us now understand the next very important aspect, which is cash flows related to investments in subsidiaries, joint ventures and associates. Now, we have not understood consolidated financial statements as of now, but still we will understand how would the cash flows related to investments in subsidiaries, joint ventures and associates be presented in the cash flow statement. Now, cash flow statement could be for the entity alone, that is a standalone cash flow statement, or it could be for the group, that is the consolidated statement of cash flows. Now, if you look at an entity alone, say for example, you have Reliance Industries. Reliance Industries has invested and acquired, let us say 75% of Farm Easy. I am just giving a number of 75%, right? Now, when Reliance Industries has invested 75% in Farm Easy becomes a subsidiary of Reliance Industries, right? Now, when Reliance Industry is presenting its standalone cash flow statement, under which category should it report the cash flow? When it is making an investment in subsidiary, Reliance Industries should present the cash flow under investing activity. So, what we understand is when an entity makes an investment in subsidiaries, joint ventures or associates, or if it is disposing them of, the cash flows associated with that will be classified under investing activity. Okay, they will be classified under investing activity. Say for example, subsidiaries declare dividend. So, if dividend is received, even that will be classified under investing activity. So, in a nutshell, whatever are the transactions between the investing enterprise and the investee, only those transactions would be reported. So, in the standalone cash flow statements of the investing entity, what the investing entity would do, they will report the cash flows when they are making that investment, or if there are any cash flows which are returned back by the investee. Say for example, investee distributes dividend. Now, when there is a cash flow from investee to the investing company, that cash flow would be presented under cash flow from investing activity. The investing company will not report cash flows of the investee company in its standalone cash flow statement. So, whenever there is an entity which is making an investment in subsidiary, joint venture or associate, cash flows related to the investments made or any return provided by the investee, only those will be reported in the standalone cash flow statement. Let us now understand how investments in subsidiaries would be presented in consolidated cash flow statements. Now, taking the same example, say we have Reliance Industries and we have Farm Easy. Now, what Reliance Industries did was, Reliance Industries invested some amount in Farm Easy and Farm Easy issued shares to Reliance Industries, because of which Reliance Industries became the holding company and Farm Easy became the subsidiary company. Okay. Now, here Reliance Industries is not acquiring shares from outsider. Reliance Industry is directly subscribing to the shares of Farm Easy and acquiring control of Farm Easy. Now, in this case, in standalone financial statements, Reliance Industries would say there is a cash outflow on investing activity. Now, when you are preparing a consolidated cash flow statement, that is cash flow statement of the group comprising of Reliance Industries and Farm Easy, think of it, is there any cash outflow from the group? See, money has moved from Reliance Industries to Farm Easy, hence there is no cash outflow from the group and these two transactions would net each other off and there would not be any cash outflow or inflow. If you look at standalone cash flow statements, Reliance Industries would say cash outflow on investing activities, Farm Easy would say cash inflow on financing activity, but as a group the transaction would net off and there would not be any presentation in cash flow statement, right? But if say for example we have Reliance Industries and we have Farm Easy, what Reliance Industries did was it acquired majority stake in Farm Easy by purchasing shares from existing shareholders. Say for example there is another entity which has 60% share in Farm Easy. Reliance Industries acquired that 60% share from a third entity. Now, in this case, while preparing consolidated cash flow statement, is there a cash outflow if you look at the group? Yes, there is a cash outflow if you look at the group as well. And in the consolidated cash flow statement, the group would present that amount as cash outflow on investing activity, right? So, if the controlling stake is acquired by purchasing the stake from outsiders, then in that case, there would be a cash outflow and that would be classified under investing activity. So, to summarize, if an entity acquires or obtains controlling interest in another entity, then cash outflow related to that would be classified under investment activities. Now, what we'll do is we'll take up a problem and understand how this consolidated cash flow statement would be prepared in case of holding and subsidiary company. So, friends, now let's have a look at a question on how do we prepare a consolidated cash flow statement when there is an acquisition of a subsidiary, right? Entity A acquired a subsidiary, Entity B, during the year. So, during the current year, they acquired the subsidiary. Summarize information from the consolidated statement of P&L and balance sheet is provided together with some supplementary information. Okay, so we have consolidated statement of P&L, revenue, COGS, gross profit, depreciation, other operating expenses, interest costs, profit before taxation and profit after taxation. This is for the group as a whole. This is not individually for entity A, it is for the entity A and entity B as a group. Now, looking into the balance sheet, consolidated balance sheet, they have given assets, cash and cash equivalents, trade receivables, inventories, PPE, goodwill, then you have total of assets. Then you have liabilities, trade payables, income tax payable, long-term debt, total liabilities, shareholders equity, total liabilities and shareholders equity. Now, one thing that you need to keep in mind is this 20x1 balance sheet is for only entity A because entity A had not acquired entity B at that point of time. This balance sheet you see here in 20x2, that is the consolidated balance sheet of A and B. The information related to A and B would be put up here. Okay, now we have not learned consolidated financial statements as per Ind AS, nothing to worry. But whatever you have learned as a consolidated financial statement as per AS, in this illustration, those principles alone would be sufficient. Okay, now when you do a consolidated balance sheet, what do? Whatever is the investments made by the holding company, that is eliminated, and against that, the equity interest is also eliminated, right? That is how you prepare the consolidated balance sheet. Moving on. Other information given, all the shares of entity B were acquired for rupees 74,000 in cash. So, entity A paid 74,000 in cash and acquired all the shares of entity B. The fair value of the asset acquired and liabilities assumed were as follows. So, you have fair value of inventories acquired, trade receivables, cash, property, plant and equipment, trade payables, long-term debt and the balancing figure being goodwill, and this is the cash consideration paid. Okay, so if you do 8 plus 4, 12 plus 2, 14. 14 plus 110 makes it 124. 124 minus 68. 124 minus 68, that would be 56. So, 56,000 is the net asset acquired, 74,000 is cash consideration paid, balance is goodwill. Now, if you see the balance sheet, the goodwill, 18,000 of this goodwill represents the goodwill pertaining to acquisition of entity B. Okay. Now, one more thing, friends, that you need to keep in mind is the company paid 74,000 in cash. They paid 74,000 in cash to acquire the entity B. But when the acquisition is made, you can see here that cash of 2,000 is also received. So, 74,000 was paid to acquire the entities. Say for example, entity A acquired the subsidiary from a third entity called C. So, entity A paid 74,000 and when it paid 74,000, it got this subsidiary called entity B. Now, when you get the subsidiary, what do? You add up all the assets and liabilities of the subsidiary in the consolidated financial statements. Now, when you look at the assets and liabilities list, you paid 74,000 and while acquiring the assets and liabilities, you got 2,000 of assets as well. So, I paid 74,000, I got 2,000 as cash and cash equivalents. So, what is my net cash outflow from a group's perspective? From a group's perspective, my net cash outflow is only 72,000. So, what is my net cash outflow? It is only 72,000. I paid 74,000, I got 2,000 like a cashback. I got 2,000 like a cashback. Net amount is 72,000. So, what will be the cash outflow on investing activities? 72,000 only for the consolidated financial statements. In standalone, you will still say 74,000, but in the consolidated financial statements, because you got 2,000 of cash and cash equivalents, you would say 72,000 only. Right? Now with this information, we are required to prepare a consolidated cash flow statement. Let us get into that. We are looking at year 2. Okay. So, cash flow from operating. Now, where do you start with? You start with net profit before taxation. How much is the net profit before tax? Net profit before tax is 70,000. So, net profit before taxation 70,000. All amounts are in rupees. So, let me note that 70,000. Now, from this you will make certain adjustments. Add less. Okay. What is the first thing you will add? Depreciation. Depreciation is a non-cash item. So, you will add depreciation being a non-cash item. Why? Because it is non-cash. How much is the amount? The amount is given to be 30,000. So, 30,000. Okay. You will add back. Then, interest cost. See, interest cost is in relation to a financing activity. It is not in relation to an operating activity. So, interest cost also will be added back. Why? Because it is a financing activity. How much is the amount? The amount given in the question is 4,000. Okay. Are there anything else to be adjusted from the P&L as such? There is nothing to be adjusted, right? So, 30 plus 4 makes it 34, which is 70 plus 34, it is 104. Okay, 104,000. Now, what is this? This is cash flow before adjustments to assets and liabilities. Now, we will have to adjust changes in assets and liabilities. So changes in operating assets and liabilities. Assets and liabilities. What are the changes? For that, you have to look at the balance sheet. Cash and cash equivalent is anyway a reconciliation item. The first item is trade receivables. Trade receivables in the consolidated balance sheet is 54,000 as at end of year 2 and it was 50,000 at the beginning of year 1. Can I say 50 minus 54, decrease in debtors is 4,000? Can I do that? Can I say 50 was my opening, 54 is my closing, so net increase in debtors is 4,000? I cannot say that. Why? Because there is an acquisition of a subsidiary, from which I got some more debtors. What is the debtors which we got? We got 8,000 of trade receivables. So, technically speaking, you have 50,000 of opening balance. To this 50,000, we added 8,000 of other debtors because of the subsidiary acquisition on the date of acquisition. So, 50 plus 8 would make it 58. Then, closing balance is 54. So, there is actually a reduction of 4,000 and not an increase of 4,000. Let me, put another example and explain this to you. Say, there is one business which has only debtors and equity, there is nothing else, okay, just hypothetically. So, debtors balance of that business is 8,000. Debtors balance of that business is 8,000. Okay, and you have equity of 8,000 for argument's sake. Now, if you acquire this entity by paying 8,000, the equity shares of that company by paying 8,000, you said 8,000 is a cash outflow on investing activities, accepted. Now, once this entity becomes a subsidiary, what do you get? You get this 8,000 of additional debtors. Now, say your own company, the holding company has debtors balance of 5,000, this is year 1, and at the end of year 2 also, let's say there is no movement, nobody has paid us anything, we have not collected any cash, nothing has happened, closing balance is also 5,000. Now, if you prepare a consolidated balance sheet, what would you say? Debtors, year 1 is 5,000, but year 2 what would you present? You would say 5,000 plus the debtors balance of the subsidiary, and assume for a moment this debtor balance also has not changed, nobody has paid us anything, so 13,000. Will you say that there is an increase of debtors by 8,000? You will not say that. Why? Because this 8,000 of increase in debtors has happened because of a subsidiary acquisition. You have paid 8,000, you have already considered that as an outflow and acquired these debtors. Again, you will not say that my debtor balance has increased, so I have collected less cash, let me reduce it in the working capital adjustment or operating assets adjustment. That is not what you do. You would say closing balance is 13,000 less debtors acquired, and this has to be on the date of acquisition. We are not doing this adjustment for closing debtors balance. Closing debtor balance will not be touching up. We are doing this adjustment for debtors as on the date of acquisition. How much of debtors did you acquire because of the acquisition? That is what we are referring to. So here you would say debtors acquired 5,000. Okay, then less opening balance is also 5,000 coincidentally. Debtors acquired was 8,000 and hence the increase in debtors is 0. Increase in debtors is 0. Don't just say that 5,000 to 13,000, there is an increase in 8,000. Remember that increase in 8,000 is because of acquisition of a subsidiary. That increase in 8,000, this 8,000 is because of acquisition of subsidiary for which the relevant cash outflow is already considered under investing activity, right? There is no cash movement under operating activities because of this. So this is how we need to calculate the increase or decrease in operating assets and liabilities, right? So just don't compare the opening balance and closing balance. Compare the opening balance and closing balance and also consider the asset value or the liabilities value of the subsidiary acquired, right? So let us do for each one of them now. Changes in operating assets and liabilities. What is the first thing? The first item is trade receivables. Trade receivables have gone up from 50 to 54, but will we present this as increase of 4,000? No. What we will do is from the closing balance of 54, we will reduce the debtors value of the subsidiary that is acquired, and with that we will compare the opening balance. So what would we do is accounts receivable. Okay, now how will you calculate this accounts receivable? You would say closing balance 54, minus what is the accounts receivable balance at the time of acquisition in the subsidiary? 8,000 minus 8,000 minus 50,000. So this is a reduction in debtors. This is actually a reduction in debtors and not an increase in debtors. Now, if you follow the logic that I had explained you earlier, you would do opening minus closing. Closing is how much? 54,000 minus 8,000 adjusted for subsidiaries debtor acquired during the year. So that comes to 4,000. You will add this 4,000. Similarly, inventories. What would you do? Take the opening balance. Opening balance is 35. Minus take the closing balance. How much is the closing balance? 30,000. Closing balance is 30,000 minus how much of inventory is acquired during the subsidiary acquisition? 4,000. So minus 4,000. So the net adjustment is 9,000, positive of 9,000. Then property, plant and equipment is not related to pure operating activities. Goodwill is a separate thing. Then trade payables. I have told you for liabilities take closing minus opening. So what is closing? Closing is 68,000 minus how much is the trade payable belonging to the subsidiary which on the date of acquisition? Payable is 32,000. So minus 32,000 minus what is the opening balance? Trade payable opening balance is 60,000. So there is a negative impact of this trade payable adjustment, 24,000. Okay. So what is the total of this? 24 minus 13, you get 11,000 negative. So cash flow from operations before taxation or before taxes is 104 minus 11,000, you get 93,000. From this you have to say less taxes paid. Now what is the taxes paid? If you see here, income tax payable, opening balance is 11,000, closing balance is 12,000. Okay. Did we acquire income tax payable? We didn't acquire income tax payable from the subsidiary. So from 11,000 it has gone to 12,000. And what is the tax for the period? 15,000 is the tax for the period. Now how do you compute the taxes paid? Take what is the tax for the period? 15,000 This is the tax for the period, right, which you were supposed to pay. So take tax for the period 15,000 plus what is the opening provision for taxation? 11,000. Assume you have paid 11,000, you have paid 11,000, that is already paid, and out of 15,000 you have paid some amount such that the closing balance is 12,000. Okay, or in other words, if you have to assume that 15,000 is also paid, 11,000 is also paid, but there is a payable of 12,000. So even if I paid this entire 11,000, from this 15,000, 12,000 is still outstanding. So minus 12,000. 15 plus 11 minus 12, you get 14,000. Okay, if you want to do it, if you want to prepare a ledger for this, provision for tax by balance carried down 11,000 to balance carried down, this has to be brought down, to balance carried down is 12,000. Okay, then during the period whatever has been debited to P&L, you will credit it to provision for taxation, that is 15,000. So 26 minus 12, you get to bank 14,000. This is the balancing figure. This is another way in which we can calculate the amount of taxes actually paid, which is 14,000. That is what we have got here, right? So what is the cash flow from operation? Net cash generated from operations is 93 minus 14, so that should be 79,000. Now let's come to cash flow from investing activity. Now if you look at cash flow from investing activity, one thing is the group has paid 74,000 to an outside entity to get control of the subsidiary. Okay, so to get the control, they have paid 74,000 outside of the group, and in return 2,000 of cash and cash equivalents is assumed during the period. Assumed means having control over that, right? Because when you are preparing consolidated balance sheet, you will consider cash and cash equivalents of subsidiary as well. And during the period, though the group has paid 74,000, 2,000 of cash and cash equivalents is still within the group itself, right? That 2,000 is within the group. So if you look at it from entity A group, entity A paid 74,000 and it acquired the subsidiary. When it acquired the subsidiary, it got 2,000 of cash and cash equivalents. So net investment or net cash outflow on acquisition of subsidiary is how much? 74 minus 2, 72,000. So cash paid to acquire subsidiary 74,000 minus 2,000, that is 72,000. Then when you come to investing activity, what are the items? Property, plant and equipment. Okay. Now when it comes to property, plant and equipment, what is the opening balance? 80,000. 80,000 is the opening balance. Then how much of depreciation was charged? 30,000 of depreciation was charged. So 80 minus 30, what is the balance? 50,000. Let me write down. Opening balance is 80,000 less depreciation 30,000. Then to this the group has assumed fresh property, plant and equipment, and what is the value given? Property, plant and equipment is acquired at a value of 1,10,000. So add PPE assumed. How much is that? 1,10,000, right? This kind of working you can do for trade receivables, payables as well. Okay, I have done it directly in the cell. If you want, you can show it as a separate working note as well. So 80 minus 30 plus 110, 160 should be the closing balance. What is the closing balance in the balance sheet? It is 160,000. Means there is no fresh acquisition of property, plant and equipment other than the property, plant and equipment acquired by assuming or by getting control of the subsidiary. And think of it, 1,10,000 is pertaining to property, plant and equipment acquired, and that is already considered in the 72,000. So, like in the case of debtors, in case of inventory, we will not say one more line item saying that we have acquired a property, plant and equipment. That is coming as a package. When you bought this subsidiary, you are getting it as a package itself. You will not again say that there is a cash outflow on acquisition of PPE. So, on PPE there is no cash outflow on investing activity. Any other items for investing activities? No other item for investing activities. So, 72,000 is the cash flow from investing activity. Then cash flow from financing activity. Now, from a group level, what is the cash flow from financing activity? Here you see there is a long-term debt, 64 to 1 lakh, and 36,000 of long-term debt is assumed during the period. 64 plus 36 is how much? Is 1 lakh. 64 plus 36 is 1 lakh. So, is there any fresh debt which is acquired? There is no fresh debt which is acquired, and hence there is no cash inflow from financing activity. Okay. Then, is there anything else on financing activity? If you come to this P&L, this interest cost of 4,000 which is paid, that is a cash outflow from financing activity. So, interest paid as above. How much is that? 4,000. So, net increase in cash and cash equivalents is how much? 79,000 operations plus 72,000. So, that makes it 1,51,000 minus 4,000, that makes it 1,47,000, right? Then, what is the opening cash and cash equivalent? Opening cash and cash equivalent is given to be 5,000. So, I think cash paid to acquire subsidiary, this has to be minus number. Okay, so if it's minus, net increase in cash and cash equivalent is 3,000. Opening cash and cash equivalent is 5,000, and closing cash and cash equivalent is 3,000 plus 5,000, which is 8,000, right? Is 8,000 shown here in the balance sheet? Yes, 8,000 is shown there in the balance sheet, right? Now, this is how we prepare consolidated cash flow statement when there is an acquisition of subsidiary during the year. It is nothing complicated. The thing that you need to keep in mind is what is the amount that is paid outside of the group to acquire or to get control of this subsidiary. That is a cash outflow from investing activity. If we are assuming any cash and cash equivalents, that will be adjusted from the cash we have paid to acquire the subsidiary. That is first thing. Second, while calculating the increase or decrease in assets and liabilities, you have to consider what is the closing balance. From that, exclude the amount of asset and liability that has been assumed during the period and compare that with the opening balance. Or, if you are getting confused in this, think of it in this way, that this 2002 balance sheet is A and B combined. So, let me write it down here. Here we have A plus B balance sheet. Here we have A balance sheet only. Okay. And we would have had B balance sheet. We would have assumed that there is a balance sheet for pertaining to B as well. Okay. So, this is year 2, this is year 1, and this is also year 1. Now, I cannot compare A plus B with A. I have to compare A plus B with A plus B, and assume for a moment it is acquired on a specific date on the, at the end of the previous year balance sheet or based on the previous year balance sheet, we have acquired. So, if we have, here we had trade receivables. What was the balance? Trade receivable balance was 54,000. And for A only was 50,000, and for B was 8,000. Now, you cannot just say 50 to 54, it's an increase of 4. You have to say 50 plus 8, 58. Compared with 54, there is a decrease of 4,000. Okay, that is the logic. And if you understand this logic, it will be easy for you to solve consolidated cash flow related questions. There is nothing complicated in a consolidated cash flow statement other than this part of remembering how to calculate the increase and decrease. Now, friends, if you see goodwill 18,000. Why did we not show this, goodwill payment as an outflow? Because that is already included as a part of net consideration. Why should we again include payment towards goodwill as a part of net consideration? So, this is how you prepare a consolidated cash flow statement. Now, some of you may get a doubt that, sir, equity has also increased from 35 to 90. Why is not there any cash flow associated with this? That is because this 35 to 90, the increase of 55,000 is because of this profit after taxation, right? So, there is no fresh equity which is issued, okay? So, the share capital remains where it is, and the share capital of the subsidiary is eliminated against the investments made. Now that we have understood how to prepare a consolidated cash flow statement, let us have a look at some specific aspects related to changes in ownership interest in a subsidiary. Now, what do I mean by this? Say for example, we have Reliance Industries and we have Farm Easy. Reliance Industries initially acquired 75% of shares of Farm Easy. Now, Farm Easy is a subsidiary and Reliance Industries has obtained a control over Farm Easy. That is how we understand this, right? So, there is a holding and subsidiary relationship. Now, assume for a moment Reliance Industries sold off 10% of its stake in Farm Easy. So when I say 10%, not 10% of 75, 10% of shares in Farm Easy to a third party. So initially it acquired 75% and subsequently it sold off 10%. Now tell me one thing, if Reliance Industries sells off 10% stake in Farm Easy, will it lose control over Farm Easy? It will not lose control over Farm Easy. In the consolidated financial statements, Farm Easy would still be represented or presented as a subsidiary, right? Reliance Industries still controls Farm Easy despite the shareholding falling from 75% to 65%. Now, when you look at the consolidated financial statements and the group has now sold 10% of its share in Farm Easy to an outsider. Can we think of that way? The entire group has sold 10% stake in Farm Easy to an outsider and collected amount for that. So this kind of transaction is classified as a financing activity. Now you might be wondering, sir, Reliance Industries, when it invested, we showed it under investing activity. Now when Reliance Industries has sold off 10% shares, why are we classifying under financing activity? See, as far as standalone financial statements are concerned, when Reliance Industries sells off 10% stake in Farm Easy, in standalone financial statements, Reliance Industries will classify it as a cash flow from investing activity. But when you are preparing a consolidated cash flow statement, that is for the group, Reliance Industries and Farm Easy as a group, when you are preparing financial statements, and when 10% stake is sold out, is Reliance Industries losing control? Reliance Industry is not losing control. So what the standard says is, the sale of 10% of stake in our example, where Reliance Industry is not losing control, is as good as raising money through selling of equity share or issuing equity share. See, substance of the transaction is the group has sold off 10% stake and collected money. Normally, when we issue equity shares and collect money, where will you classify that? You will classify that under financing activity. So in case of a group of companies where the holding company or the holding entity does not lose the control over subsidiary company and there are some transactions related to equity, that is acquiring additional stake or selling off existing stake without losing control over the subsidiary, in that case we classify the cash flows as cash flow from financing activities. So just to summarize, when an entity purchases stake or gets control of a subsidiary, you will classify the cash flows under investing activity. Subsequently, if there are any change in the ownership interest, then you have to see whether control is lost or control is retained. If control is retained, if the control is not lost, then any such transactions related to equity will be classified under cash flows from financing activity. If control is lost, then cash flow from investing activity, right? So the thing that you need to keep in mind is changes in ownership interest. If control is not lost, you will classify the cash flows under financing. If control is lost, you will classify the cash flows under investing activity. Now the classification of cash flows under financing activities where control over subsidiary is not lost, this requirement is not applicable to an investment entity as defined in Ind AS 110. Now, what does Ind AS 110 talk about an investment entity? That is nothing but an entity whose sole purpose is to acquire investments in other entities. We'll understand about this in more detail when we go to Ind AS 110, but for now just understand that there is an entity. The purpose of this entity is to acquire investments or is to make investments in other entities, right? This umbrella entity, which is classified as investment entity, and this investment entity measures the investments in subsidiary as fair value through profit and loss. In that case, the requirement to classify changes in ownership interest as financing activity is not applicable. In a nutshell, if it is an investment entity, it is making investments into some subsidiaries and those investments are measured at fair value through profit and loss, then cash flows related to such investments will always be classified as an investment activity, right? So, to summarize, if the cash flows are related to obtaining control or losing control over a subsidiary, you will classify them as cash flows from investing activity. Then, if there are cash flows but there is no loss of control over the subsidiary, then you will classify those cash flows under financing activity. Exception, if it is an investment entity which is measuring investments using fair value through profit and loss, in that case, any cash flows related to purchasing shares in a subsidiary, selling of shares in a subsidiary will always be classified as cash flow from investment activity. Now, when we talk about a subsidiary, there could be a case where we have a foreign subsidiary, a subsidiary in a foreign country where the foreign currency is different and our own functional currency is different. Now, how do we convert the cash flows of a foreign subsidiary to the cash flows in functional currency? Can we use the closing rate or can we use a weighted average rate? The standard says you have to use the rates which are applicable on the respective date of transaction. So, whatever is the exchange rate applicable on the date of transaction, those dates should be used to convert the cash flows of a foreign subsidiary into the functional currency, right? Don't worry much about this. When we do Ind AS 21, we'll understand how do we do the conversions, what is presentation currency, what is the date of transaction, right? What is the functional currency, all of that we'll understand. Now, whenever there is a case where an entity has either obtained control over another entity or has lost control over another entity, it has to make some specific disclosures. What are those disclosure requirements? The first is the total consideration paid or received. So, what is the total consideration which is paid to get control over a subsidiary or that is received when the entity has lost control over a subsidiary? Then, the portion of the consideration consisting of cash and cash equivalents. So, there could be a possibility where, say for example, we have Reliance and we have Farm Easy, and Reliance has acquired shares in Farm Easy from a third entity, okay. Let us say the existing shareholders or existing founders. Now, when Reliance acquires shares of Farm Easy, Reliance can pay cash or Reliance can issue shares or Reliance can make a combination of cash as well as shares, right? All of these combinations are possible. For instance, if you look at how Facebook acquired WhatsApp, there was a component of cash, there was a component of equity as well, right? So, it can be a combination. So, you need to disclose what is the total consideration. Out of that, how much is cash and cash equivalent? Then, the amount of cash and cash equivalent in the subsidiaries or other businesses over which control is obtained or lost. Now, what does this mean? See, we took one example where the company paid some amount, let us say 50,000 to get control over a subsidiary, and in the subsidiary books there was an existing cash balance of 3,000 for example. So, 50,000 is the total consideration, 3,000 is the cash or cash equivalent which is assumed by the holding company or which is assumed by the acquiring company, that has to be disclosed. So, basically how much is the cash and cash equivalent on the date of getting control or on the date of obtaining control in the subsidiary books, and the amount of the assets and liabilities other than cash or cash equivalents in the subsidiaries or other businesses over which control is obtained or lost summarized by each major category. So, basically give a broad summary of what are the various assets and what are the various liabilities using, grouping them into major categories, that is appearing in the balance sheet of the subsidiary on the date on which control is obtained or on the date on which control is lost. Now, this last two requirement C and D is not required to be made by an investment entity. Let's have a look at a question. Company A acquires 70% equity stake in Company B on July 20th of year 1. The consideration paid for this transaction is as follows. So, you have cash consideration of 15 lakhs, 2 lakhs equity shares having face value of 10 and fair value of 15 per share. So, 15 into 2 lakhs, 30 lakhs, right? On the date of acquisition, Company B has cash and cash equivalent balance of 2.5 lakhs in its book. On October 10th, Company A further acquires 10% stake in Company B for cash consideration of 8 lakhs. Advise how the above transaction will be disclosed, presented in the statement of cash flow as per Ind AS. Now, in this case, Company A has acquired 70% equity stake in Company B. Now, this means Company A has obtained control over Company B. Which date? July 20th of year 1. Now, whenever there is a cash flow associated with acquiring control or obtaining control, then you will disclose those cash flows under cash flow from investing activity. And friends, please note, we are talking here about the consolidated cash flow statements. So, what is paid? Cash paid is 15 lakhs. So, that cash paid of 15 lakhs will be disclosed under cash flow from investing activity. But will we show the amount of 15 lakhs? Or should we also adjust the amount of cash and cash equivalents which are assumed? Now, if you look at the question, it says 2.5 lakhs is the cash and cash equivalent balance in the books of Company B on the date of acquisition. So, 15 lakhs is what is paid minus 2.5 lakhs of cash and cash equivalent which is assumed. So, the net cash outflow under investing activity is 12.5 lakhs. Then, what do we do with this 30 lakhs of shares issued? Is it a cash flow related item? that is not a cash flow related item, but we have understood that the total consideration paid, cash or non-cash, the total consideration paid has to be disclosed. So, these 30 lakhs of shares issued have to be disclosed separately. Then, the company further acquired 10% stake for cash consideration of 8 lakhs. Now, when there is a further acquisition, in that case, we have to see whether control is lost or not. Now, see, logically, if an entity acquires more shares, will control be lost? The control will not be lost, right? So, by acquiring additional 10%, there is no loss of control, and hence, in this situation, the cash flow associated with that additional 10% acquisition should be treated as cash flow from financing activity unless company A is an investment entity. So, what will the cash flow look like? Cash flow from financing activity, there is an outflow of how much? Of 8 lakhs. Now, if you want to understand this, just think of it as the group purchasing 10% stake from outsiders. Group purchasing 10% of its shares from outsiders, 10% of company's B share from outsiders, and when they do that, there is a cash outflow and there is a reduction in the share capital held by outsiders. You can think of it in that way, right? As if the group has bought back its own share. You can understand it that way, right? So, that cash flow will be shown under cash flow from financing activity. It will be an outflow for the group. Another requirement under Ind AS is to provide disclosures related to changes in liabilities arising out of financing activities. Now, this term may sound complex, but it actually is not complex. What it basically means is, what are the changes in liabilities due to financing activities? What is the opening balance? What are the changes? And what is the closing balance? You please disclose that. Now, the changes can be because of multiple reasons. The standard gives 5 broad heads. What are those 5 broad heads? First, changes from financing cash flows. So, basically say there is a loan outstanding. There is a loan outstanding, a long-term loan outstanding, and the company has borrowed additional loan. Now, when the company has borrowed additional loan, is it a cash flow from financing activity? Yes, it is a cash flow from financing activity. Is it creating a liability? Then, the next question that you need to ask is, by taking additional loan, is my liability changing? Yes, the liabilities are also changing, right? So, you had some amount of loan at the beginning, you took additional loan, your closing loan balance or the closing liability on loan would be different. So, what the standard says is, whenever there are changes in liabilities due to a financing activity, whenever there are changes in liabilities due to a financing activity, that has to be disclosed separately. So, some reasons because of which there could be changes in liabilities, the standard says could be changes from financing cash flows. So, changes because of maybe obtaining loan, repaying loan, payment of interest, etc. that has to be disclosed. Then, changes arising from obtaining or losing control of subsidiaries or other business. So, because we have acquired a subsidiary or because we have lost control over a subsidiary, there could be a change in the financing liabilities that has to be disclosed. Then, the effect of changes in foreign exchange rates. Now, finance liability could change because of a change in foreign exchange rate. Maybe when we borrowed money, the exchange rate was 75. So, 1 lakh multiplied by 75 say will become 75 lakhs. By the end of the year, the exchange rate has become 80. 1 lakh multiplied by 80 would be 80 lakhs, right? Now, there is a change in the finance liability. This will have a cash outflow from financing activity in the future that has to be disclosed. Then, there could be changes because of changes in fair value. We will understand this in financial instruments in detail, that whenever we are valuing a liability under fair value, there could be a change because of that and any other changes. So, basically what the standard says is, if there is a change in any liability because of a financing activity, that is, right now there has been a cash flow related to that, or in future there will be a cash flow related to that, that has to be disclosed. So, you are basically preparing a kind of a reconciliation statement. In what format, where it has to be presented, that is not prescribed. So, basically this would be forming a part of notes. If the entity already presents these kind of changes separately, what the standard says is, liabilities which are arising out of financing cash flows, for that you have to show a separate reconciliation. You may be presenting overall changes in liabilities at one place, but that is not sufficient. What are those liabilities which are impacted by financing activity or financing cash flows? For that, prepare a separate reconciliation. Now, moving on to the next requirement of the standard, which is basically reconciling the cash and cash equivalents presented in the balance sheet with the cash and cash equivalent presented in the cash flow statements, right? We have briefly touched upon this when we did the foreign currency cash flows. Now, what is this reconciliation all about? Now, think of it, for example, a company has cash at bank 50,000 and there is a bank overdraft of, let us say, 20,000 with another bank. Okay, so there is, or maybe same bank also possible. So you have a bank balance of 50,000 and overdraft of 20,000, right? Now in the financial statements, you will not net them off and show under cash and cash equivalent. This 20,000 would be shown under your liabilities and the 50,000 would be shown under your assets. But when you are preparing the cash flow statements and assuming for a moment that this bank overdraft is a part of overall cash management plan of the entity, then in that case, you will net them off and show cash and cash equivalents to be net at 30,000, correct? So, when you are presenting 30,000 in the cash flow statement and in the balance sheet you are showing cash at bank 50,000 at one place and a bank overdraft as 20,000 in some other place, what the standard says is, please reconcile these two items. Please tell the users that cash and cash equivalents as per cash flow statement is so much. This is the reconciliation item, that is basically 20,000 of overdraft, and this is the cash and cash equivalent presented in the balance sheet. Similarly, when we took that foreign exchange example, I incorporated one item called exchange difference reconciliation or reconciliation for exchange difference, right? Now, such kind of reconciliation has to be presented so that the cash and cash equivalents in the balance sheet are tallying or are in line with the cash and cash equivalents as presented in the cash flow statement. A simple requirement, right? Now, say for example, you have $1,000 at the beginning of the period, you have the same $1,000 at the end of the period, but during the period, exchange rate moved from 75 to 80, right? Now, cash and cash equivalents in the balance sheet will be how much? Will be 80,000. But as far as the cash flow statement is concerned, there is no cash inflow. 75,000 became 80,000 and there is no cash inflow. That 5,000 will be a reconciliation item. Let's now understand some other disclosure requirements under Ind AS 7. Now, the first requirement is with respect to restricted cash and cash equivalent. Say for example, I tell you there is a company which has a cash and bank balance of 1 crore. Now, when you just see cash and bank balance, you feel that, oh nice, this company has 1 crore of cash balance. But what if I tell you that out of this cash and bank balance or cash and cash equivalents, 50 lakhs has been used to create a deposit against which a bank guarantee has been issued by the bank, and that fixed deposit of 50 lakhs cannot be used by the entity. So, that amount of 50 lakhs is restricted. It is not available for use by the entity as at the end of the reporting period. So, if at all there are any restricted cash and cash equivalent items and these are significant, that has to be disclosed separately. Otherwise, the users will not know whether that amount is available or not. Sometimes we have a requirement that you have to maintain a minimum bank balance. Even in case of current accounts, there may be a possibility that the bank requires the company to maintain a minimum bank balance and below which it cannot drop. So, say for example, if the bank says out of 10 lakhs of cash and cash equivalents, 1 lakh has to be a minimum balance that has to be maintained. So, 1 lakh is restricted, only 9 lakhs can be used. Or say for example, the entity has cash and cash equivalents at a foreign country or a foreign location from where repatriation is not allowed easily or only a part of money can be repatriated. Maybe the entity has $1 lakh, but out of that $1 lakh, 30% cannot be repatriated. 30% has to be kept in that country. The company cannot use it. Something like that, right? So, if there are any restrictions, that has to be disclosed separately. So, the standard says an entity shall disclose together with a commentary. Now, what is the meaning of commentary? Commentary means basically describing. Together with a commentary by management, the amount of significant cash and cash equivalent balances held by the entity that are not available for use by the group. So, what are the cash and bank balances? What are the cash and cash equivalents that is not available for use by the group? Group here means when we are preparing consolidated cash flow statement. Even if the entity is preparing a standalone cash flow statements or a separate cash flow statement, there also this requirement would apply. Maybe there could be a case where the bank balance has been attached by one of the authorities. Maybe income tax authorities have frozen the bank account. Possible. That amount is not available for use by the entity. That has to be disclosed separately. Then, the standard also requires disclosure of certain additional information which helps the user to understand the financial position and the liquidity position of the company. Now, some of them are the amount of undrawn borrowing facilities that may be available for future operating activities and to settle capital commitments, indicating any restrictions on use of these facilities. So, what does this mean basically? Are there any undrawn borrowing facility? So, undrawn borrowing facility basically means the company has a credit limit, but the company has not utilized a credit limit. Now, if anyone of you have been using a credit card, or you may ask your parents who are using a credit card comes with a limit. Let us say the limit on the credit card is 1,50,000. So, I can use up to 1,50,000. But I have used only 30,000 out of that. Means 1,20,000 is undrawn. I can draw whenever I want. Similarly, for companies, what bank do is they give a credit limit or a credit facility. Say a company is sanctioned credit facility of 100 crores. Now, the company can borrow up to 100 crores and say the company has borrowed only 20 crores. Balance 80 crores can be borrowed during the term of the sanction at a future date. So, 80 crores of cash and cash equivalent will be available to the entity. This is the fact that has to be disclosed. And if at all there are any restrictions to these borrowings or unused facility, even that has to be disclosed. Then, the aggregate amount of cash flows that represent increase in operating capacity separately from those cash flows that are required to maintain operating capacity. Now, this is more like a management information being given, that is, how much of the cash flows have been spent to maintain the operating capacity, that is, to continue at the current level of operations, how much cash is being spent and how much cash flow is spent to build additional operating capacities. So, basically this talks about your capital maintenance for existing level of operations, how much of cash flows is being spent, regular repairs and maintenance, right, regular upkeep of equipment, regular training of the employees. To maintain at the current level, what is the cash outflow? To enhance the operating capacity, maybe to bring in some efficiencies, to add capacity to the plant, to expand the plant, right. For them, what is the cash outflow? That has to be disclosed. Then, the amount of cash flows arising from operating, investing and financing activities of each of the reportable segment as per Ind AS 108. So, when we come to 108, we will understand reportable segment. Ind AS 7 talks about for each of the reportable segment, show separately operating, investing and financing cash flows. Let us see what kind of disclosures we get to see when we look at a cash flow statement. So, you see the notes here below the cash flow statement. There is a detailed cash flow statement format of Nirma Limited I have taken. Okay, the long cash flow statement. Cash flow from continuing operation, operating activities. Okay, then a long cash flow. So, you can see cash flow from operating activities, then you have adjustments for gain on sale of investment or security capital, CWIP written off, loss of asset, interest, finance cost, a lot of these adjustments. Then operating profit before working capital changes, then adjustments for increase, decrease in whatever the items what we do, cash generated from operations, direct tax paid, net of refund, direct tax paid, net of refund. Then net cash from operating activities, then cash flow from investing activities, purchase of property plant, sale of property plant, sale of investments in subsidiary or associates, non-current investments, current investments and all of that. Then you have cash flow from financing, loans and advances, short-term borrowings and repayment of short-term borrowings, and then long-term borrowings, lease rental, interest paid on lease, all of those things, and redemption of debentures. Then net cash increase or decrease, cash and cash equivalents at the beginning of the year, adjustment due to some demerger, so there was some demerger activity, and cash equivalents at the end of the year. Movement in cash and cash equivalent pertaining to discontinued operation, a separate note has been given on that, right. Then they say the cash flow statement has been prepared under the indirect method, and you know what Ind AS says, they encourage the use of direct method. Listing requirement is indirect method, but they encourage the use of direct method. Then disclosure required by Ind AS 7 cash flow statement for changes in liabilities arising from financing activity. So, this is an important part which I wanted to show it to you. We understood one disclosure where we said changes in liabilities due to financing activities has to be disclosed. So, what they have done is they have said this is the opening balance of borrowings, opening balance of lease. So, borrowings and lease, non-cash movement. So, whatever are related to accruals which do not have cash impact or cash flow impact, that has been disclosed. Then cash movement, proceeds from borrowings, repayment of borrowings, repayment of lease, interest repayment of borrowing, interest repayment on lease, all of that has been disclosed, and closing balance of borrowings and closing balance of lease liability has been given. Then during the year, cement undertaking is demerged and the same is considered as a non-cash transaction, that is disclosed. And then the other disclosures what are given as a part of cash flow statement, right. So, again I encourage you to read through the cash flow statements of some listed entities. You will get really beautiful insights to understand the cash flow statements. So, we are now done with Ind AS 7 on cash flow statements. Let's quickly summarize whatever we have discussed in the class. We divided the cash flows into three categories: operating activities, investing activities and financing activities. Operating activities are those activities which are principal revenue generating activities, and any other activity which cannot be classified as either investing or financing activity. Then we spoke about investing activity. These are to do with acquisition of long-term assets, acquisition of other investments, investments into subsidiaries, whenever we talk about an item of asset being recognized in the balance sheet, which has to do with the long-term assets like property, plant and equipment, or investments, maybe investments in debentures, investment in shares, something like that would be classified under investing activity. Now, when we talk about investing activity, we do not include cash and cash equivalents under this. Then we have financing activity, which is to do with the equity and borrowing composition of the entity. So, issuance of share capital, redemption of share capital, borrowings, all of those are your financing activities. Then we understood about cash and cash equivalents. Cash represents cash in hand, demand deposits with bank. Then what are cash equivalents? Cash equivalents are short term, generally up to 3 months, highly liquid, can be converted into cash very easily. Investments which have an insignificant risk of changes in value, those are what are classified as cash equivalents. Now, when we talk about a cash flow statement, we can prepare a cash flow statement using the direct method and indirect method. Now, please note the distinction between direct and indirect is only with reference to operating activities. For financing and investing activities, you will anyways present the gross receipts and gross payments. Now, when it comes to direct method, you will summarize all the receipts and payments, shows taxes separately. When it comes to indirect method, you will start with net profit, make changes with related to non-cash items, items belonging to other categories, make adjustments for changes in operating assets and liabilities, and show taxes paid separately. Then while preparing cash flow statements, we have understood that the cash inflows and cash outflows have to be presented separately. You cannot net them off except under certain specified circumstances, and we understood under which circumstances we can present the cash flows on a net basis. For example, if the cash flows are primarily the cash flows of the customers and not of the entity, in that case we can present it on a net basis. We took the example of cash deposits and withdrawals by customers. Similarly, we looked at other examples where we could present cash flows on a net basis. Then we understood about how do we present foreign currency cash flows. Basically, the foreign currency cash flows would be converted to the functional currency using the exchange rate on the date of transaction, and if at all there are any exchange differences which are unrealized, they have to be adjusted while preparing the cash flow statement, because the unrealized exchange differences do not represent any cash flows. Now, when we are using the indirect method, we will basically adjust the unrealized exchange gain or losses, and if at all these exchange gain or losses which are unrealized pertain to cash and cash equivalents, they have to be shown as a separate line item, as a reconciliation item in the cash flow statement. Then we also understood about cash flows related to obtaining control in a subsidiary or losing control in a subsidiary, that has to be classified under investment activity. But once the control has been established and there is a change in the ownership interest whereby the entity or the holding company does not lose control, in that situation cash flows associated with those items will be shown under financing activities in the consolidated cash flow statement. Now, this requirement to disclose the cash flows under financing activity is not applicable for an investment entity which is measuring the investments in subsidiary as fair value through profit or loss. So, just to understand, if you are acquiring control or losing control, in that case you will show the cash flows under investing activities. If there is a change in ownership interest and there is no change in control, the company is not losing control, in that case we will disclose the cash flows under financing activities. And friends, please note, when you are preparing a consolidated cash flow statement and a subsidiary has been acquired during the period, what would you do? When you are computing the increase or decrease in assets or liabilities, you will adjust the assets and liabilities which has been assumed at the time of obtaining the control of the subsidiary. Then lastly, another important thing that you need to keep in mind is to provide a reconciliation between cash and cash equivalents as per the cash flow statement and cash and cash equivalents as per the balance sheet. Let's now quickly have a look at the differences between IAS 7 and Ind AS 7. The item of differences are interest paid, received, and dividends paid and dividends received. First, I will take up dividend paid. Now, dividends paid as per Ind AS 7 has to be classified under which activity? It has to be classified under financing activity, right? Dividends paid will be classified under financing activity, whether it is a financial institution or any other institution. Whereas, as per IAS 7, you can classify dividends paid as a part of operating activities. That is one item of difference. Then, second item of difference is with relation to dividends received. Dividends received for a financial institution under Ind AS 7 is an operating activity. For other entities, it is an investment activity. But IAS 7 gives an option that in IAS 7 gives an option that dividend received can also be classified under operating activities. Then, now coming to interest received. Now, interest received for a financial institution is under operating activity. For other entities, it is under investment activity, whereas IAS 7 gives an option that you can classify interest received under operating activities. Then, lastly, interest paid. When you talk about interest paid for financial institution, it's an operating activity. For other entities, it is a financing activity. IAS 7 gives an option that interest paid can also be classified under operating activity. So, this is the broad difference between Ind AS 7 and IAS 7. Let's now understand the difference between Ind AS 7 and AS 3, that is our Indian GAAP. Okay. The first difference is with relation to bank overdraft. Now, Ind AS 7 specifically provides that if bank overdraft is a part of the overall cash management, then it has to be considered as a part of cash and cash equivalents, whereas AS 3 did not provide any such guidance. Then, under Ind AS 7, there was a specific item of cash payment where cash payment was made to acquire property which would be subsequently given on rent to others. See, the rental income is anyways a part of the operating activity, that is different. But after the asset is used and it is held for sale and subsequently sold in the ordinary course of business, the sale of that asset would also be classified under cash flow from operating activity. AS 3 does not provide any such guidance. Then there is specific guidance in relation to cash flows related to investments in joint ventures, associates, subsidiaries, acquiring, obtaining control, losing control, additional disclosure in relation to obtaining control of a subsidiary or losing control of a subsidiary. Such specific guidance is not available under AS 3. And under Ind AS 7, we do not have any concept of extraordinary item because the entire Ind AS does not have any concept of extraordinary item, whereas AS 3 required that any cash flow related to an extraordinary item has to be presented separately. Let's have a look at another question from Ind AS 7. From the following data of Galaxy Limited, prepare statement of cash flows showing cash generated from operating activities using the direct method. So, by using the direct method, you have to show what is the cash generated from operating activities. So, they have given us extracts of balance sheets, current assets, inventory, trade receivable, cash and cash equivalents, trade payables and provision for taxation. And they have given us sales, cost of sales, other income, interest income, fire insurance claim received. Now, as far as this fire insurance claim received is concerned, we do not know whether it is against inventory or it is against PPE. So, we have to make an assumption. We will assume that this is against inventory, and because it is an insurance claim received, we will classify it as an exceptional item and present it separately. Then, depreciation is given, administrative, selling expense, interest, foreign exchange loss, net profit before tax, income tax, and net profit is given. And they have mentioned that trade receivables and trade payables include amount related to credit sale and credit purchase only. So, it is only relation to operation. Foreign exchange loss represents increase in liability of a long-term borrowing due to exchange rate fluctuation between acquisition date and balance sheet date. So, this foreign exchange loss, whether we don't know whether it is realized or unrealized, but this is not pertaining to operations, this is pertaining to your financing activity, and if it is a realized thing, it will be an outflow. If it is an unrealized thing, there is no cash flow associated, right? Now, because we have to prepare it on using a direct method, what we need to do is, we need to find out how much of cash we have received from customers, how much of cash we have paid to the creditors, then how much of cash we have paid to a taxation. Apart from that, other expenses, admin and selling, we can directly take it up from here, and fire insurance claim received will be an item of cash inflow, right? Apart from this, there is no complexity in this question. So, let us start solving this question. Cash flow from operations under direct method. Okay. So, we will say cash collected from customers, first item, then cash paid to suppliers, then cash paid for admin expenses. Okay, there are three items. So, first let us calculate each of this. Working note number 1, trade receivable account. Now, here you have balance to balance brought down. What is the balance brought down? The balance brought down, that is opening balance of trade receivable, is given to be 1,88,000. So, 188,000, right? Then sales is 85,50,000. 85,50,000. Okay. Then by balance carried down, how much is the balance carried down? By balance carried down, the question says 2,05,000. 2,05,000. So whatever is the balancing figure, that is the amount collected from customers. So by bank, this is the balancing figure. How much is that? 188 plus 8550 minus 205. You get 85 lakhs 33,000. Right. So cash collected from customers 85 lakhs 33,000. Then cash paid to suppliers. Now before we reach, now to compute cash paid to suppliers, we need to know how much is the purchases that has been made by the company. Now how much is the purchases made, that we can know by using this cost of sales. Now if they have used the term cost of sales, we can assume that this cost of sales is the cost of goods sold in totality, right. Now you have inventory, opening balance, closing balance, and you have cost of sales. Using that you can calculate the purchases, and using that you can calculate the amount paid to trade payables. So working note number 2 for purchases. How do you calculate purchases? Purchases is equal to your closing inventory, that is your closing stock, whatever you have in hand, plus cost of sales, whatever you have sold, minus opening stock. Okay. Now please remember this formula: closing stock is equal to opening stock plus purchases minus sales. This formula, if you remember, this equation, to derive this equation will not be a difficult task, right. So how much is closing stock? Closing stock or closing inventory is 1,20,000. So 1,20,000 plus 56 minus 165. So 1,20,000, I will write here, 1,20,000 plus 56 lakhs minus 1,65,000. This is the purchases, that is 55 lakhs 55,000. Now once you have the purchases, you can prepare the trade payable account. Working note number 3, trade payable. Now to calculate the amount paid to trade payables, we can prepare an account that like we have done in case of trade receivable, or we can prepare a statement as well. So let me prepare a statement for this. If you want, you can prepare a trade payable account. Okay. So now when you have to prepare a trade, now if you have to calculate how much have you paid to the trade payables, what you need to say is what is that you have purchased, that is one aspect. Then what was payable in the beginning, that is another aspect, and how much is yet to be paid. If you subtract that, you will get the amount paid to the trade payable. So what is the opening balance? Opening balance is for trade payable is given to be 2,15,000. So 215 was payable at the beginning. Add purchases, how much you have made? 55 lakhs 55,000 less closing balance. Closing balance is 1,95,000. So this will give you the amount paid to trade payables. 215 plus 55 minus 1,95,000, you get 55,75,000. So amount cash paid to suppliers is 55,75,000. So let me put a negative number here. Then we have admin and selling expenses 15,14,000. So minus 15,40,000. This is for admin and selling expenses. Okay. Then apart from that, is there any other outflow? There is income tax and there is this exceptional item. So exceptional item is an inflow. Cash flow from operations before exceptional item is how much? 14,18,000. Add cash inflow from insurance claim. How much is the cash inflow from insurance claim? 1,10,000. Cash flow from operations before taxes is 14,18,000 plus 1,10,000, 15,28,000. Then less taxes paid. How much is the tax paid? Again, please prepare a ledger and see how you can compute that, or please prepare a statement and see how you can compute that. I will directly compute here and show it to you. That working note for tax payable is basically a practice for you. Okay, I will not be doing it again and again because now you are at final level and you must understand how those numbers have been arrived at. Now as far as taxes paid are concerned, income tax expense is 95,000 and provision for tax is 65 and 48. So assuming the way I remember is, and you have to show it as a working note. Okay, if you show the number without the working note, you will not get marks. So provision for taxes opening is 65,000, which we are supposed to pay, plus the expense for the period 95,000 also we are supposed to pay. Okay, but how much is the closing balance? 48,000 is the closing balance. So we have not paid 48,000. So we have paid 1,12,000. This you can show it as a negative number. 1,12,000. So what is the cash flow from operations? Cash flow from operations is 15,28,000 plus 1,12,000 minus 1,12,000, 14,16,000. Now we have done this question using the direct method. What I wanted to do is do the same question using the indirect method. Basically what I mean by that is take net profit before taxes. Take net profit before taxes 1462. Carry out the adjustments. What are the adjustments you will carry out? See, this interest income is an investment activity. You will show it separately. So you will adjust that. Fire insurance, you can add it and then show it as a separate item called an exceptional item. Then depreciation non-cash, you will do an adjustment. Interest expense is a financing activity. Foreign exchange loss is again not an activity related to operating activity. You will adjust that as well, right? Then you will do the adjustments for your assets, inventory, trade receivables and trade payables. Now please note friends, you will not do any further adjustment for provision for taxation under the indirect method because you have directly taken taxes paid. You are directly taking up taxes paid, so there will not be any further adjustment for this, okay? And using that, please calculate and see how much do you get as cash flow from operations by using the indirect method. That is more for your practice.